Beijing?
I think what you're seeing now and what we've seen over the last 24 to 48 hours is more coordinated response between the Ministry of Finance and between the People's Bank of China. You've had this effort now by the PBOC to allow the banks to let go, reduce their reserves around some of their foreign exchange holdings, and therefore make the yuan a little bit more attractive, try and shore up the downside that we've seen for that currency. On the other side of the table, you've seen the Ministry of Finance coming through and now implementing some of these decisions around real estate. So making it easier, for example, to get a mortgage, making the cost of getting a mortgage lower, the down payments coming in smaller in cities, the big cities like Shanghai, but the smaller second-tier cities as well. So you're seeing closer coordination in terms of the policy that's coming through. Yes, we have not seen that overarching bazooka-style policy. I don't think we're going to see it, but you have seen these additional measures. It's becoming more coordinated, and importantly, it is being implemented on the ground. Is it enough? Short term, maybe. You saw a little bit of sentiment reviving in the equity markets and the yuan today. Medium to longer term, the questions very much remain.
Well, Tom, to that point, it feels like I've woken up every single day the past week or so to another targeted measure that Beijing has rolled out. And maybe there's some signs that that's starting to work. What we've seen from the manufacturing PMIs, for example, is the worst of the factory slump behind us. Is it too early to say that?
I think it probably is. You're right to focus on that Caixin survey. It's an interesting survey because it focuses on private businesses and smaller companies, so not the big state-owned enterprises. That data came through with the official data, and that remained weak. But you're absolutely right. When it comes to that Caixin survey of smaller private firms in China, manufacturing back in expansionary territory, for how long is the question? And also the timing of these policy measures. The window is narrow because of the slowdown in the US, because of the slowdown in Europe. Has the window closed for these responses to come through and make a material difference when the rest of the world is slowing and demand for Chinese products arguably is reducing? That is a key question. So manufacturing remains a spotlight. Importantly, services and consumption. And the team at Bloomberg Economics are crunching the number on some of these measures that come through in the last couple of days. And they have said, look, it is going to do something to shore up consumption. We know how important that is for Chinese policymakers. They want to shift that focus onto the consumer by cutting these mortgage rates. Bloomberg Economics thinks they'll be able to do that short to medium term. They also think, by the way, it could add about 1% to GDP.
And Tom, your point about that ideological straitjacket is well taken, but there's a great story on the terminal about how the slowdown that we're seeing in China is a real opportunity for countries such as the U.S., some of their economic rivals, if you will. At what point does the data weaken to force Beijing out of that straitjacket?
I mean, that is the central question, isn't it? You know, are the policy measures, of this flurry of measures they pushed through over the last few weeks, going to be enough to alleviate some of the pain? They have a greater ability now to be able to absorb a slowing economy. When I was in China, the question mark used to be, if you get below 7%, is that when social stability starts to fray? That is the level, arguably, that policymakers are concerned about. That was the view 5, 10 years ago. This is a leadership now. This is a communist party headed, of course, by Xi Jinping, who has, it seems, the ability to absorb more costs, more pain. You look at the unemployment numbers, again, amongst China's youth, 20% amongst China's youth. I mean, that is on a level similar to Spain, Italy, and Greece. They've taken a lot of pain. I think this is a communist party and a government that is ready to take a little bit more. They don't want to see that debt. They've worked through some of those debt issues. They've managed to pull back some of those shadow banking issues in the last 5 to 10 years. Yeah. They don't want to see that revived. They're not at the pain point right now. They realize that there's going to be further downside. These additional measures are going to come. The challenge remains.
We got to ruin your lunch more often, Tom McKenzie. Thank you so much. In London, Tom McKenzie leading our London coverage this morning, and of course, all of his good expertise on China. It is Jobs Day. Futures advance. Why not? What is it? 5 days up in a row? Bull market. VIX 13.47. Futures up a solid 15 as well. Thank you to Team Surveillance and particularly the care and expertise of John Farrow for yesterday's discussion with Max Verstappen. He is ginormous in Formula. And Katie, I know you're all over that interview and what's going to happen at Monza. That's where Farrow is. I mean, you know, he went over to Monza. Max got him tickets.
You know, I got to say, I'm not super familiar with Formula One.
Yep.
I do know that Netflix show, Drive to Survive.
You been watching it?
No, I have not watched
Gotta
it.
watch it. Addictive.
Apparently, my brother and my sister-in-law watched it. Now they're apparently huge Formula One fans.
Yeah, that's what's
I haven't
happened.
seen it.
Well, Max made very clear yesterday he's not a fan. And Farrell was grilling him. I mean, John was just outright rude.
Yeah.
And, you know, Max made clear he's not a fan of the Netflix
Why
show.
not?
He's a traditionalist. I mean, that's the kid's 25 years old. He's like Michael Jackson, equivalency within the sport, and he's winning. And of course, he won it in the Netherlands last week, and now they're in Italy, where Ferrari's supposed to win. They won't. And you know, Max is going to do it again, is the assumption for Red Bull. But this was a great moment, thanks to John Farrell. Really, he let me participate.
Oh, he did.
Yeah, I'm expert.
Can I say on the Drive to Survive? I understand that this man is a traditionalist. He doesn't like it, but in a way, he should be grateful because I'm a huge track and field fan. I went to the World Championships in Budapest last weekend. Actually, we would love a version of Drive to Survive. You have to beg people to care about track and field.
It's always been that way. I was thinking about that. The NBC did a great coverage of the track and field, and it sort of preempted what they're doing with English soccer. And you know, I know there's a whole political thing into do it, and there's contracts and agreements and all that. But you're absolutely right about that. It was game-changing for Formula One. And even now, folks, with I believe it's 3 races in America with Las Vegas coming up, Farrell's angling tickets from Red Bull.
Is he?
For us to go to.
We're going to do a surveillance special.
Lisa, me, John, Las Vegas. It looks good.
Yeah.
But the answer is, even with the Drive to Survive, Formula One globally is ginormous compared to what it is in the United States. Thanks to all at Red Bull yesterday for that effort with Mr. Verstappen. Back to the jobs day, and we do the data here. Futures up 14, Dow futures up 121. Yields are just a jumble. I don't know what to say about them. The real yield, I don't know what to say about it, 1.87 on the 10-year real yield. I'm watching oil. We may get an 88 print on Brent crude. That will be an important statistic. Renminbi with all the China news. 7.26 yuan. On jobs day, many coming up. Krosner coming up. Jeffrey Rosenberg of BlackRock coming up. And David Kelly out there somewhere is a negative non-farm payroll statistic. Stay with us from New York on radio, on television, Bloomberg Surveillance.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. The top names in global leadership are on Bloomberg.
When the dust settles, Israel will not only remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think of myself as a realist, trying to see the world as it really is and not the way I'd like it to be. And sometimes I succeed and sometimes I fail in that.
If you look at the economic data, I mean, it just keeps coming in, showing a tight labor market. We keep getting these numbers, strong spending.
In essence, we're seeing the economy is genuinely slowing some, but it's not falling off the cliff.
I think the equity market is focused on earnings.
We are in this sort of lull, waiting for the labor market to catch cold so that we can actually, yes, stop this acceleration in wages.
At the end of the day, the question going forward is, can the consumer continue to live beyond means?
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Jobs Day. Farrow off, Bramo off, Catherine Greifeld in. She'll be doing the real yield at some point here, recorded after the jobs report. You'll look for that through the weekend as well. And on a Jobs Day, a great set of guests. We'll get to that in a moment here. What we've got is an equity celebration. It continues. The Bears in retreat in August. Futures up 15. Dow futures up 119. The VIX, a bull market, 13.47. We don't have the banner, but as I mentioned yesterday, coming off the lows, the VIX from 31 flipped the numbers down to a 13 handle. That shows a shock that we've seen here. Katie Greifeld, I look at the bond market. I guess it's a churn, but with a 4.10%. Anyway here, the ambiguity or the guessiness of the bond market into October, November is wide open.
It's pretty stunning to think that in August we got to 4.36% on that 10-year yield, really definitively broke out of that range, only to settle back in. It's going to be fun to see what September brings, especially for the equity market. I don't know if you put much stock into seasonals, Tom, but September is typically pretty ugly.
We got $88 a barrel on Brent crude, 87.96. We may get an 88 print there by the time we get done talking to David Kelly. We'll get to that in a moment. I want to run through the data here. We're going to do this here an hour and a half away from jobs. Again, green on the screen here. NASDAQ up less. SPX up 0.3%, up 16 big points. Again, I mentioned the VIX, which I think is important in a slow motion holiday market, 13.47. I have to mention Bitcoin, or Greifeld will walk with a tantrum off the set.
Thank you.
And the answer is 25. It's under 26,000, plummeting off of the Gensler moment last week. We'll talk about that with Katie when we get a moment. But Bitcoin 25,992.95. I'm never going to mention the cents again. 10-year yield 4.10%. And again, over to foreign exchange, you got a churn to the market, maybe off the strong dollar moment of the last couple days. Euro 109 now 108.44. In yen, quiescent at 145.41. What's your observation today, Katie, that you see?
I would say in the conversation that we're having about oil, to bring it back to the bond market, you take a look at break even, those inflation expectations. Even though we're looking at these back-to-back gains in the oil market, inflation expectations continue to fall off a cliff, of course, as we continue to see real yields rise. There's a lot of really interesting dynamics underneath that nominal yield.
You mentioned Tom McKenzie, that great conversation with his experience in Beijing. Here is a headline. They come out, I think Beijing's on a 20-minute PR route right now. The Bloomberg headline, Beijing eases home buying mortgage rules. There have been a series of these out. We're almost up to the edge of uncountable micro headlines of what to do about an economy that's not running at 5%.
And to bring it back to that Tom McKenzie conversation, the ideological straitjacket, I thought that was a great phrase that he used, that they're so unwilling to release that big bazooka, I think is the term he used, of stimulus, and instead we're contending with this drip feed. And the open question is whether that makes a difference.
And we'll see that with renminbi right now, 7.26. A stronger renminbi, a stronger yuan, rather, I should say. Interesting to see how that fares into their Monday morning, call it our Sunday evening. It is Jobs Day. We do it right. Humbled by the guests that have shown up here across the extended American Labor Day. Ellen Zentner of Morgan Stanley. Nadia Lovell of UBS. There on the equity market tie-in. Randa Krosner, he has been so committed to the show, the gentleman from the Booth School, arguably our greatest financial economist. And Jeffrey Rosenberg of BlackRock will look at yield here off of the jobs report. Just really thrilled with this lineup that we've got this morning. If you go back through a year, there are single moments where things stop on the show. David Kelly is trophy taking this year. A number of months ago, the chief global strategist, JP Morgan Asset Management, simply said, we're going to see negative non-farm payrolls. Dr. Kelly joins us again this morning. I guess not negative non-farm payrolls this morning, David Kelly, but boy, the vector's in place. How do you extrapolate out to the shock of a negative non-farm payroll statistic?
Well, that's right. I mean, it's not going to be today, we don't think, and probably still quite a few months out. But if you look at the decline in job openings, it's been pretty significant. We've gone from 12 million job openings in March of last year down to about 8.5 million right now. A number around 7 is, I think, normal for this labor market. So as we get to that point, the sort of immunity that excess job openings has given this labor market is going to wear off. And then the labor market is going to really represent a sort of a lagged result of whatever demand we have in the economy. Now, what's been good is demand has been strong, but I still think that as we get into early next year, the risk of seeing a month with negative payrolls rises, and I think that will change the picture.
And of course, if we do get that negative payrolls print, it's going to be an interesting communication challenge, both for the Fed and the Biden administration. But I want to situate this conversation in the conversation we've been having about the economy, that soft landing debate. There's still plenty of camps out there saying that this landing will be harder than expected. But you take a look at what we're seeing in the job market. And in this economic cycle, David, is it possible that we could see a recession at full employment?
Well, a recession is when you depart from full employment. But I think what's the problem is not really a problem, but the problem is we've got 3.5% unemployment. We've had it for a year. And when you're at full employment, essentially, the economy can only grow at a relatively slow pace. And so you're basically one banana skin away from something that's going to put you into a negative GDP situation. We're not there right now. I mean, this economy has outperformed this year, both in terms of growth and bringing inflation down. And to me, the most striking thing about the Federal Reserve's forecast is we're actually more optimistic on them on both growth and inflation over the next 18 months. We think that the economy, we think unemployment could stay below 4% for a while here, and that inflation will come all the way down to 2% or lower by the end of next year. So I think that's good. But we are in a situation where, you know, as the months go on, the distortions in the labor market are gradually wringing themselves out of the system. And so we're going to be in a more normal economy with all the risks that entails.
On the topic of 2% inflation, do you need to see the unemployment rate get above 4%, or is it possible to have both slowing job growth, not necessarily fall off a cliff, but also get back to target?
Absolutely key question. I think that you can get to 2% without bringing the unemployment rate up to 4%. What we're looking at is there's a lagged effect on shelter inflation and on transportation services. As those things unwind through the course of 2024, I think the PCE deflator will come below 2% on a year-over-year basis, even if unemployment doesn't go up. And I think the key thing, you know, why is this different from the 1970s? Because we don't have strong trade unions. You know, yes, you've got decent wage growth, but that's really compensation for past inflation. Workers aren't militant in demanding high wage increases, and they're certainly not getting them.
Right.
And I think that means that as the economy slows down, wage growth will moderate, and you can get that. You can get inflation down to 2%, even if unemployment's below 4%.
This is like the David Kelly in my youth, working with Bob Goodman over at Putnam, the idea of the vibrant American economy. Let's go to the laureate, Ned Phelps of Columbia, David Kelly, talking about our dynamism. There is a doubt out there about the post-COVID dynamism of the American economy. Do we underestimate, not so much fancy things like productivity, but do we underestimate the ability of corporates to adapt, the verve to keep it going?
Yeah, I think we do underestimate that. I mean, if you look at corporate profits in the first half of this year, they've really been very good. I mean, with all the strains that American corporations have been facing, to actually maintain those margins, to find ways of holding labor in place, of investing in new technology. There's a lot of excitement around AI. There's a lot of investment spending going on. A lot of companies are adapting to this environment. So yes, there'll be losers in the economy. There'll be losers among companies, but we've got a lot of vibrant American corporations, which I think can drive this economy forward.
We can rip up the script with Dr. Kelly here. We do this with Bostic of Atlanta, I believe in South Africa, and a quote from Raphael Bostic: "There are reasons why our star might rise." This is a raging nerd debate, folks. We're going to go there with the Geek Squad led by David Kelly right now. David, come on. Our start is a bunch of plugins. We don't know this, we don't know that. Are you looking for us to subsume, as John Williams says, and get back to a historic lower R star, or can we reset constructively higher?
We should abandon R star altogether. The R star is the idea that there is a specific interest rate which holds this economy in balance. But the truth is at low interest rates, the impact of interest rates themselves on economic activity and on inflation is very minor. So why are we so fixated on setting it? I think really what happens is the Federal Reserve overshoots on both directions on interest rates, distorts financial markets, causes long-term problems without actually properly modulating the economic activity. So we should stop trying to aim at an insignificant little distant star like R star. The level of interest rates is not significant enough in predicting economic activity. It just causes distortions. And the Federal Reserve ought to try to get back to a more normal level of interest rates and not distort financial markets by trying to over impact the economy with a variable that is really just not that effective.
Bottle it, folks. That dissertation from Trinity Dublin and David Kelly was classic. We'll have that for you on Bloomberg Digital and, of course, across all. That was a wonderful effort by Dr. Kelly to explain a school of thought that our star is basically a jumble of mathematics. That was really, really an important statement by Kelly of JP Morgan. Katie, I can't say enough about what Kelly just said there about the math frenzy of American economics. That was the gentleman from Ireland talking.
Throw it away. Abandon our star.
I don't know if I'd abandon it, but I'd lose it as a study point with, as Olivier Blanchard of France says, there's enough other factors out there to make your head spin as well. That was a brilliant moment of our September here. Right now, on a jobs day, the Standard & Poor's 500 up 0.3%. We welcome all of you on radio and television here on Jobs Day. Ellen Zentner coming up, Randall Krosner coming up. We take a minute here on Bitcoin. You mentioned earlier the SEC, Gensler, having a tough time. Did the people that want to package Bitcoin into investable products, did they have a good August?
It was a good August. It came at the very end, even though there's plenty of more hurdles that we have to cross to get to that spot Bitcoin.
I can't buy a Bitcoin ETF by Christmas.
You could if you go to Europe. If you want to do it in the U.S., it might be a little bit difficult. It's not just Grayscale who's trying to do this, though. You have some of the heaviest hitters out there, BlackRock, Invesco, Fidelity. They all have applications for this type of product. So what happened this week, it wasn't approval, but it was a needed step to get to approval.
So what's the next step here? What's the next judicial step here? Does it, to use the theater, go to the Supreme Court?
leaving aside what's going on with Grayscale and the SEC, the fact that we do have active filings from BlackRock, from Invesco, the list goes on, the SEC has to respond to those. They actually had a deadline this week. They've already delayed that decision. They can do that, and it was expected. The next date to watch, I believe, is mid-October, is the next point at which they'll have to respond. So we'll see. There's a lot of paperwork. There's a lot of meetings to be done at the SEC between now and then. It's going to be a fascinating fall, at least in the Bitcoin community.
So you're going to stay through 8:35 now that we've done the required Greifeld crypto
That's my
quota?
plan, yeah.
Oh, her agent is trouble, I tell you. Futures up 16, Dow futures up 122, the VIX 13.45. It is Jobs Day. Important to listen to Ellen Zentner, the chief U.S. economist at Morgan Stanley. Stay with us on radio, on television. It's Bloomberg Surveillance.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
We don't have shared values, but we have a shared planet, and we have to work with the Chinese to save the planet, because they're now, I think, the biggest emitter. If not us, they're second, and they're part of the solution in all of this.
Nancy Pelosi, as we said earlier, a change to Nancy Pelosi. She was Speaker of the House with the weight of herding cats, and now it's a very different Congresswoman from California. Important comments there to Bloomberg, not only on China, but also her hope, as she sees it, that a Republican Party will find a path after former President Trump to something that she remembers from her youth. Katie Greifeld is in today for Lisa Abramowitz and John Farrell. Thrilled. Thank you so much for watching today. It was some great guests lined up here to get to Jobs Day as well. I just had an email in. Yes, we'll continue to cover Bitcoin. Thank you for that oddity of the price to get Greifeld on. Futures advance up 17. They continue to advance. We're in a bull market, 5-6 days up in a row. I noticed Apple doing well just as a market bellwether, 4.10%. And a 10-year yield. That's not Brent crude. For those of you on radio, you look at TV and your eyes cross over. That's 84.75 on American oil. West Texas Intermediate up 1.3%. Brent crude, I'm pennies away from an 88 print on Brent crude, and that may be the quiet story into the weekend off of the jobs report. We're going to go tangential, rip up the script as we can always do with Anne-Marie Horton, extremely well read in on Bloomberg, on Washington, I should say, and our Bloomberg Washington correspondent. Anne-Marie, very quietly, and the Washington Post leads this morning. I'll read the headline from Nick Murloff. Families crossing U.S. border illegally, and here's the money quote, reached all-time high in August. I believe this has slipped by the summer, Anne-Marie. How upsetting is the immigration story in Washington on a sleepy September 1st?
Well, I don't think it's really slipped by the summer if you see what's going on, one, at the border, and you see constant calls from especially Republicans who want to make this a campaign issue going into the 2024 presidential election next November. But also we have seen recently really the escalating tension between top Democrats in the party. I'm talking about the Biden administration, and New York City Mayor Eric Adams for months has been asking the federal government for help with migrants that are in New York State. He's now joined by Governor Kathy Hochul, as well as some top business leaders, writing a letter to the government asking for more help. You do see the government coming out and looking at federal buildings they can use. I think one of them is a tax office on Long Island. But they are asking for help because the city says it's going to cost them billions of dollars, and they are just running out of space. It's a fractured moment you see between top Democrats, very interesting before the presidential election. But potentially this problem is going to get worse because people are feeling like they are running out of resources.
Are the both parties on the same page? Is it like China where there's a bipartisan panic? In this case, over immigration, one statistic going from 100,000 arrests in June on the border up 70% to 177,000 arrests. Is there any sense of bipartisan, or is there the normal polarity?
So I think when you think about immigration as a whole, when you talk about any sort of chance of bipartisanship, it comes back to individuals who want to see really a remake or a revamp of immigration law, and they want to make sure they're getting this under control. But Republicans daily bash how the Biden administration is handling the border. Even something like what the Trump administration wanted, build the wall. Not much of that wall has been built. Some are so campaigning they want to finish building that wall. That is something that the Biden administration is not going to do. One thing you saw the Biden administration do, especially when the president went to Mexico, is they're trying to house more in Mexico before they come over the border. But this is a very difficult situation, and if migrants come in and they make it to places like New York, it becomes a humanitarian situation. So it's incredibly sad. It's incredibly difficult. But I would say the bipartisanship really only starts and ends when it talks about revamping immigration law. But how you deal at the border, there's a lot of stark differences.
Let's talk a little bit where there is some degree of bipartisan agreement, and that's with China. Of course, U.S. Commerce Secretary Gina Raimondo wrapping up her trip. And Anne-Marie, it seems like she's leaving with more than we've seen from past trips from Biden administration officials this summer.
Well, she's leaving with this opportunity to have a more frequent dialogue, I would say, with her Chinese counterpart, as well as a working group that'll be set up to talk about the commercial ties between these two countries, which she really wanted to emphasize that could be the bedrock of this relationship, because obviously you see China and the U.S. spar when it comes to export controls and sanctions. And there's also going to be another dialogue when it comes to those export controls so that China feels like they truly understand what is going on. I would say, though, there was a bit of a wink, wink, nod, nod that happened on her way out of China. And that was when Huawei released a 5G phone that many are saying Bloomberg hasn't been able to independently verify what actually went into this phone, but it blew up in Chinese media. And it really showed that Huawei was able to circumvent the sanctions that are placed on them to develop this phone. Remember, they were put on the entities list in 2019 by the Trump administration. They've been a major target from the United States. So that was a little bit of the timing, I thought, was suspect, coincidental, or potentially on purpose.
Yeah, and it's an important reminder that there's still a lot of distance between the two sides here. Let's talk about a little bit about the top brass. When we think about President Joe Biden, a potential meeting with Chinese President Xi Jinping, walk me through this. I thought that they were supposed to meet at the G20 summit this month. It seems like Xi Jinping is planning to skip that now.
Yeah, it does look like Xi Jinping is not going to be attending. Reuters reported this, and then we've reported that China has just not given their response yet, their RSVP, if you will, to the Indian government. It does look like Xi Jinping is going to skip it. And then in another potential dagger to the United States, in October, a month after the G20, we've reported that he's invited President Putin to come to China. This will be Putin's first trip out of Russia since there's an arrest warrant after him for alleged war crimes by the International Criminal Court. He'll be attending China's Belt and Road Initiative. So this was going to be an opportunity potentially where Biden and Xi Jinping, even if it wasn't a full sit down, the way they had in Bali, that really restarted the talks, and what the Biden administration wanted to see, more healthy dialogue between their cabinet members and Chinese ministers. We won't see that there then, but I still maintain to be continued till the end of the year. The United States is hosting APEC, and there is a chance Xi Jinping will attend that in November. So that would be the really last opportunity of the year for these two individuals to sit down.
Anne-Marie, thank you so much. Anne-Marie Horton with us, our Chief Washington correspondent here. And, of course, Balance of Power, look for their efforts here into the powerful September that we have ahead. I really want to draw your attention to the equity markets, and I think we need to frame out where we are. There's been so much gloom that we've seen. And just to give you some perspective here on what Standard & Poor's 500 has done over the summer, and particularly, Katie, going back pre-pandemic, a lot of the pros are gauging now, and this is unusual because of COVID, but they're sort of saying, okay, where was free cash flow pre-COVID? Where is it now? And the answer is bouncing off the bottoms of October, the bull market that we're in, or gauging it to where we are from the peaks here in the recent weeks. The answer is it's been pretty good. Back 4 years. Do you feel like the Standard & Poor's 500 is up 13% per year pre-COVID?
Pre-COVID,
I don't think the feeling's out there.
I would believe it, though.
There it is. I mean, 7 stocks, but it's a lot more. But that's a really substantial return now, hard to believe, across 4 years as well. I did a comparison with Apple as well. I mean, everybody talks about Apple. Thank you to Dan Ives for real wisdom. My eyes are hurting still from when he came in. Apple, under the same guise, up 37% per year.
And you think about how consistent Apple is, and you talk about free cash flow, and Apple has, more cash than Ireland? I forget what the current stat is, but that's a company you can rely on to continually deliver. But
there's some real suspect here into September. Our Mark Gurman leading our world-class coverage on Bloomberg. Everybody hangs on what Mr. Gurman says, and of course all of that will move to September with Bloomberg Technology on Bloomberg Television as well. On Jobs Day, Ellen Zentner next. This is Bloomberg. Good morning.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
We've had the market analysis. We're going to go get straight to some breaking news.
We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
One hour away, the jobs report for August, hugely anticipated, along with an inflation report coming up in a number of days as the Fed staggers to a September meeting. I guess it's pause, but who knows? We are data dependent. We'll be data dependent in 1 hour. Randall Chrysler coming up, the former Fed governor as well. With the importance of our guest, we're going to get right to it here with futures up 17. Nice lift to the market this morning. Let us go under surveillance with Catherine Geifeld joining us this morning. Is everybody except me and Damian Sassauer. Sassauer's working. Did you know that?
From home.
He's work from home. We'll get to that in a moment. Sassauer's work from home. Anne-Marie Horton wasn't work from home.
No,
She's
that was a
in the
nice
office.
studio shot.
We'll get to that in a moment. It's a backdrop she has. She's actually working from beach as well. China has been part of the story here, ramping up efforts to boost the yuan. They were successful by 3 decimal points, 7.26 right now on yuan, but it's a steady drip. We're still, I would suggest we're in still the single headline, so what mode. There's no drama here.
No drama. It's interesting to see them come out in support of the yuan once again. They've really ramped up support specifically for the currency. Remember all of those fixings that we got that were super strong. Now we're getting the reserve ratios starting to move a little bit. We'll see if that works. I mean, China yuan weakness has been the story of the summer.
And right now, to move on to a next view here under surveillance, and this is really cool. How about spanning from northern Western Australia? You go up from Perth, you go way up where the snakes are, and then you go out a zillion miles, like 50 miles out, and there's an island which is like LNG Central. Mm-hmm. And they're having problems in Australia is unionized workers, they rejected a pay offer from American Chevron in Western Australia, and that affects globally, including Europe with Ukraine. This is not a small matter.
Yeah, these 2 Chevron facilities account for about 7% of global LNG supply, rather. And we talk about strikes in the context of the American economy all the time, but this is a really important reminder. This is becoming a global issue that we're talking about.
Right now, we're going to sit on this for a moment before we get to Ellen Zentner. And the basic idea is everybody is sort of trying to figure out 2024, beginning September, Labor Day, in America, what's the new work from home? Wall Street's looking to get workers back in the office as the summer closes. Beautiful grid by Bloomberg of what each is doing. Each firm has their own attitude. James Gorman at Morgan Stanley, like the accent got going, he was getting a little angry there. And he said 2 things. He said, if they can have dinner in Soho, they can come to work. And he said if they can stand in a trout stream, they can come to work. I mean, I thought it was pretty good.
Well, you think about what Jamie Dimon said.
What did
he said this to the Economist in July. Completely understand why someone doesn't want to commute an hour and a half every day. Totally got it. That's a direct quote. Doesn't mean they have to have a job here either. It's a pretty hard line.
Yeah, it's getting harder, Len. I think the tendency here, seriously, folks, and this is, of course, a huge topic for our Manhattan, but the intensities picked up on September 1. So
today, actually.
Today, yeah. I think today is the day where we launch out here, and it's past Labor Day and into Wednesday and Thursday next week. Leading the charge, I would say, is Goldman Sachs. King Solomon has said, get in the office.
Yeah.
And it's as simple as that. We don't have any sympathy, do we? I mean,
we're here every day. I don't know. We might have differing opinions here. I know that Paul Sweeney wants everyone back in the office. I think hybrid work.
There's a little tension with Greifeld, different opinions on crypto, different opinions on work from office. Helping us here with the new labor economy is Ellen Zentner, who was in the Troutstein when Gorman said, Ellen, get back to work, which she has done. She's working 7 days a week for Morgan Stanley. I want to get to Jobs Day in a moment. What's your guesstimate on the impact of the American economy of work from home?
Work from home, I think, can have some real benefits to productivity. I think we're forgetting
Nick Booth
that
at Stanford agrees.
Yeah, and I believe that there is a chance for women that would normally have low labor force participation rate to increase labor force participation because of the flexibility that it offers. I think that there's a chunk of the population of disabled folks that could work more fully. Or have work opportunities given the flexibility.
What's the problem Wall Street is? I don't want to get in trouble with Fortress Gorman here, but you were down in Soho having lunch and James is going, what is she doing? What's the problem with Wall Street CEOs? They all have 4 houses. They have a helicopter. They're like, well, should we be in the Hamptons or up the Hudson River? And everybody else is disabled or can't work. I mean, what's the attitude adjustment that there needs to be across all of corporate CEOs?
I think that for me, I make individual decisions for my team. And I was very flexible before COVID, and I remain flexible now. But that flexibility doesn't mean that you don't come into the office and interact with folks. And especially for the younger employees at the firm, the younger employees understand that they need that connectivity. And they want to be in. And so I provide an example that when I'm not traveling, I'm in every day. But do you have to be in if you have kids to drop off at school? Is it perfectly acceptable to be in a bit later? Can you finish work at home in the evening if you didn't get it done during the day? Can you extend your vacation by vacation for a week and then work from there for a week? I love those arrangements, and that is a good deal of flexibility.
I gotta say, I love everything Ellen is saying. I think it sounds...
Now, come on, be a journalist, be fair and balanced, Kate.
Fair and balanced, but I think you make some great points. Let's bring this to what we're gonna get in less than an hour.
Nice segue.
I'm trying here. We're gonna get the jobs data, and aside from the headline number, what we're gonna see on wage growth, I'm sure we're gonna talk about that, but talk to me about labor hoarding. That's a dynamic that started to pop up. You have employers cutting back on hours versus shedding staff numbers altogether. Is that the typical dynamic we tend to see at this point in a labor market?
Not to this extent. And I think it started with earnings transcripts last year around March, where we started to see hints of this. And so part of our stress back then that we were going to see a soft landing was that we would see job gains slow but not fall off a cliff, because companies then have increasingly told us and are still telling us, I'm going to hang on to my current headcount. I can control costs by reducing hours. I want to be prepared for a pickup in business later on because it's been so difficult to hire. So what does that mean? It means right now you look at the JOLTS data that came out this week, job openings are down sharply, right? But quits are also down, firings are down. There's very little churn in the labor market, which means you're taking pressure off of wage growth. But it also doesn't mean that jobs just fall off a cliff. They're going to continue to slow here.
Is that dynamic masking what we're seeing at the unemployment rate level? Because at the same time, we're seeing the average hours worked go down, but the unemployment rate is not budging.
Yeah, so I think, look, an issue for policymakers now is to say, where is the appropriate level of unemployment? We've seen some start to say maybe it is very low. I think one of the most encouraging things that I think Chair Powell is very happy about as well is that they've been able to start inflation in the right direction. They've been able to slow employment, and they've been able to do it without significantly raising the unemployment rate or raising the unemployment rate at all. Yeah. And that's a beverage curve effect. The beverage curve, which relates job job openings to unemployment is normalizing. It's normalizing. And so we're able to bring those job openings down without raising the unemployment rate.
Your initial claim, which I was privileged to witness, was on consumption, on retail. We're sitting here with grim, broader American retail sales in that. Give us your consumption dynamic right now, the retailness of America.
Yeah, so I think, Sarah Wolf on my team, who's our consumer economist, loves talking with you, Tom, and has been on this show before. And look, the consumer bottom line has been stronger than we expected this year. There are factors that have been pushing that. You've got very lumpy, volatile categories of motor vehicle sales, which is just a supply issue and pent-up demand issue, right, pushing up spending. But underlying that is deceleration in discretionary spending this year. It's that undercurrent of lower-income households have been having issues. They don't have the excess savings. Their wage gains are, though, still turning positive, finally, because inflation is coming down. So consumer spending, and this goes into the soft landing as well, is slowing. It has been more resilient. We've released recent research on the Barbenheimer effect, the Taylor Swift Eras Tour, and Beyonce.
How many times have you seen Taylor?
So I have not. My niece did, and I hear I'll be able to see her in the theaters in October. I mean, she has been a juggernaut this year. And look, we all go to concerts. People go to concerts, and we've had this increasing demand for experiences. And yet, this was extraordinary. I mean, she is a juggernaut that has generated revenues on the order of the Olympics. Beyonce as well. I mean, there's about $1,500 per person spent to go to those concerts.
What's your number on unemployment where behavior changes to 0.1%? Is it 4.0? Is it something round about 4? Is it 4.x%? Where does our behavior, our construct of labor change?
Yeah, so I think it comes more, and on the part of households, it comes more on what are they hearing from their neighbors? What are they hearing from their friends? What are they seeing with their coworkers? We've already seen, without a deterioration in the unemployment rate, we've already seen that assessment of households this week from the Consumer Confidence Survey really plummet. And so either they're going into the labor market right now and having a tough time finding jobs, or they're hearing that from their neighbors and friends. And so I don't think we have to have a tremendous amount of increase in the unemployment rate for folks to really start to buckle down and get worried about their future finances.
And Tom, I'm sorry, I do want to go back to Taylor Swift for just a minute, and I have a good reason why, because Anna Wong of Bloomberg Economics actually put out a piece that said, a Swift summer papers over cracks in the job market. And to your point, it's been like the Olympics. She writes that basically this demand, this surge in demand that we've seen for leisure and hospitality workers, that's partly driven by Taylor Swift's concert tour, and that's going to fade.
It is going to fade. And so research that we released this week showed that, okay, you have Taylor Swift, Beyonce, Barbenheimer all hitting in the third quarter, peaking in the third quarter. Now Taylor Swift moves on to take Europe. But in the fourth quarter, that fades. It fades. And now these one-offs doesn't mean that the undercurrent is super soft for the consumer, but you are going to have to deal with that. And we think that consumer spending is going to decline in the fourth quarter.
You don't think after Barbenheimer, the March meeting of the National Association of Business Economics is going to pick up the GDP slack?
We try.
We tried.
I try. I shop all the time. My husband will tell you. I'm insatiable. I really try to do my part.
Ellen Zentner, the newly minted president of the National Association for Business Economics, selling the religion there. The religion on Jobs Day is simple. Standard & Poor's 500, up 0.4%. On radio and television, Ellen Zentner with us right now with Morgan Stanley. I want to dive into the granular nature of the report. What is the character of our unemployment right now, and particularly temporary workers versus full-time workers?
Yeah, so temporary workers have been picking up, and that can pick up for good reasons or worrisome reasons, depending on where you are in the business cycle. And so temporary workers, when they're picking up, either you're unwilling to hire full-time because you're uncertain about the economic environment, or it's the start of moving from temporary to full-time. So we're really focused on that. Do we continue to see temporary employment decline in today's report? And what does that mean? Is it worrisome, or is it something of just normal? Are they moving to full-time?
This is a spectacular window, folks, into the ambiguity of the two roads. I've always, in my study of this, particularly with the Federal Reserve Bank of St. Louis, is it's hugely ambiguous what you do. People talk about temporary jobs with certitude. Baloney. We have no clue what it's going to be.
Yeah, well, I think that's why each time one of these large reports comes out, it is always a mixed bag, and there is something for everyone in it. If you're a bear or a bull, you're pessimistic, optimistic, there is something for everyone. I'll tell you, you said something at the beginning of the show that the Fed was going to stagger into the September meeting. I think Chair Powell could swagger into the September meeting, because whatever the data does, they've got time on their hands, an incredible amount of time to follow the data.
Very good. Ellen Zentner, thank you so much for joining this morning. She is with Morgan Stanley. She's lifted the markets. Only Zentner can do that. Taylor Swift and Zentner can do it. Futures up 17, Dow futures up 135. Stay with us. It's Jobs Day in 45 minutes. Krosner, next.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
10% correction is not totally unlikely if the economy starts to soften up globally, and if you have still inflation that is above essentially target, with core being still high in US, UK, Europe, central banks hiking somehow more. I would not be surprised if in the second half of the year you get a 10% correction in global equity markets.
Nouriel Roubini is not as good looking as Amal Clooney, Rita Ora, the former speaker, Nancy Pelosi, all attending in Venice, Italy last night with Francine Lacqua, the 2023 DVF Awards. This is Ms. von Furstenberg, and this is a real lineup of ability in Venice to close out the summer. And of course, Francine Lacqua must attend on her way with the Clooneys up to Lake Como to just, do what they do at Ambrosetti. Mohammed El-Arian has told me this is the greatest junket of all time. Serious conversation about Italy, about finance, and about Italian banking, pulling the most difficult job on Labor Day in America from Lake Como, Italy, and Cernobbio, our Francine Lacqua.
Yeah, Tom, I'm on an Italian road trip, but only to the glamorous places. But we also have to get back to business and talk banks, because there was a little bit of thing called a windfall tax that was unannounced and then suddenly announced, and the markets freaked out a little bit. So I'm delighted to be joined by the Intesa chairman. He's Gianmaria Grospietro, to talk about the bank that the markets frankly didn't take so well. Chairman, thank you so much for joining us. I mean, this was a surprise. It must have been a surprise for you. You're one of the biggest banks in Italy. What was your reaction to the windfall tax?
Well, it was a surprise, but not a terrible surprise. I don't think that the windfall tax will be dramatical for the Italian banking industry. But the reaction of the investors was not expected, even by me, because the consideration of the Meloni government has always been positive. It is considered reliable. Now the investors have been spooked by something that they didn't comprise completely. That was the problem.
But the investors were spooked, and then they said, okay, I understand. So for example, for Intesa, they may lose up to 1 billion. They may maybe change a little bit of what they give back to shareholders in dividends, and then they've moved on. Is that how much it will cost you, 1 billion?
I think that with the new correction that has been already decided, we will be below 1 billion. But the fact is that at this moment, we do not know what will be the final situation, because the Parliament has 2 months for approving or modifying the decree that is till October 8th.
So what are you doing at the moment? Are the Italian banks lobbying the government? What would be your best outcome in this kind of scenario?
I don't know. I don't know, because there is an active debate on the political side. And in this moment, the question is a political one. So we are only spectators. But anyway, I have the opinion that this will not a dramatical effect for the Italian banking industry. Indeed, the situation is good. The economy is doing well. We have experienced a slowdown, but not grave. The Italian economic structure is good. The family, the household savings are good. So,
for Intesa, could it actually change the way you look at dividends and giving back to shareholders?
Well, if we have a lower profit, we will have lower dividends, of course. We have given a dividend policy of 70%. So that is the question. But anyway, dividend will be good in any case. So I think that our shareholders will be satisfied. Especially because we are not only producing dividends, we have an industrial plan which is made of concrete targets. We are facing a twin transition, digital transition and climate and technological transition. So our investors, our shareholders are satisfied. We are doing something concrete.
Chairman, talk to me a little bit about interest rates. So they've gone higher quite a lot. Is there political pressure to actually give more to savers? And how will that change the business models, not only of your bank, but all European banks?
Well, dividends and interests are a commercial fact. There is a market. What I think is good is that the market is competitive. And competition is rising, also in paying deposits, but it's rising especially on time deposits. And there is a movement from sight deposits to time deposits. And this is a sound movement, both for the depositors, for the customers, and for the borrowers and for the banking industry, because time deposits is the right way to finance lending.
Tom Keene calls me up every week, our co-anchor in the U.S., and he asks me, what is stagflation in Europe going to look like? You paint a pretty optimistic view about the economy, but do you worry about low growth and high inflation that we cannot control?
Well, we have experienced a slowdown in growth, but Italy has done better than France and Germany, and we have very resilient SMEs. We have an economy which is more distributed with export destination and sector destinations or sector specialization. So we are very positive also for NPLs. We don't see difficulties in NPLs.
But the government here in Italy is also trying to change Italian capitalism. Whether it's small or big, do you worry that international investors will be much more wary of investing in this country?
No, I don't think that this country will be abandoned by international investors because the yield is very good, and the government has been very responsible both in the economic policy and in the foreign policy. That has been appreciated.
Gianmaria Grospietro, thank you so much for joining us. As always, that was, of course, the chairman of Intesa. With that, Tom, I'm going to send it back to you, but look at this view. It's difficult, right, sometimes to talk about bad loans and banks when you have such a beautiful view.
Francine Lacroix from Venice to Lake Como to who knows where next, maybe Saint-Tropez for the weekend. Francine Lacroix there, of course, and look for Leaders with Lacroix each and every month out on Bloomberg, out of London, Queen Victoria Street as well. It is Jobs Day. There's a lot going on, and people are publishing and working today. Torsten Slok over at Apollo is not work from home, and it's just really, really simple. He's got an incredibly terse note here. And Katie, this is something you follow every day. Katie Greifeld in for Lisa and John this morning. Real special Jobs Day. Slok. Since the Fed started raising rates, deposits in the banking sector have declined near $1 trillion. Over the same period, almost the same amount has gone into money market funds. And the chart he's got, which, you know, doesn't matter what the chart is, all you need to know, this is a melt-up, Katie Greifeld. From my ute, this is a huge, huge deal.
It's a huge deal, and it's a huge issue for those smaller, mid-sized banks that have to pay up to keep these deposits. You remember that double downgrade that we got from S&P and Moody's on those regional lenders in August? It was the deposit issues that they really highlighted. Even though we're past peak panic that maybe we saw in March, that deposit story, the flow of deposits into higher yielding money market accounts, it's going to be a slow-moving but big issue for these banks.
And the other thing we've got is Citigroup out moments ago, the Holland Horse Combine. I mean, you know, he's got like 42 people working for him. And the question is strikes. You mentioned UAW, and there's I think they get less cred, less respect, but the actors and all that. I mean, Vet Bill, my dog, Vet Bill, he's got a SAG card. Vet Bill's on strike. He's not crossing the picket line on Fifth Avenue. But the bottom line is Citigroup looks at a 40,000 drag just from the LA strikes.
And then you think about the impact on wage growth too, those wage pressures. It's pretty amazing.
We're a half hour away here. We're going to get into this and really move on. Promise me, 8:31, you're not going away. Jeffrey Rosenberg will be upset if you leave at 8:31. It's Jobs Day, Bloomberg Surveillance.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
The top names in global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
Right now, we don't see enough evidence that a recession is imminent.
Earnings are going to have to drive things for the stock market in the U.S.
I don't think that we'll be seeing the Fed cut drastically.
Maybe this September meeting is a skip, not a pause. Maybe we will go again in November.
We still think they're probably going to hike one more time in November, but that's probably going to be the end of the cycle.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It's Jobs Day in America, the Super Bowl, 13 times a year, the game. And then also each and every month we have Jobs Day here, and we'll go beneath the headline data as we always do. The same lineup as always. Thrilled at their commitment here on Labor Day. Krasner of Booth School. They're already back in school. It's no big deal for the former Fed governor to be on the show today. Jeff Rosenberg will join us here. I'm not sure which beach he's coming from. Nadia Lovell will be with us here in moments with UBS as well. And we celebrate, speaking of Nadia Lovell, Katie Greifeld pulling the shortest of short straws here on Jobs Day. Futures up 15. I mean, the equity market just advances.
It just advances. I don't know what changed in August. Maybe it's just summer trading. We'll see if that momentum continues as we really get into the meat of September. I don't know how many people are going to stick around after 8:35 today.
Well, we're going to convince him to stick around. Jeffrey Rosenberg will help us get out strong here in the half hour. We'll do our uninterrupted coverage here coming out of the jobs report to give you a brief here forward into September. I want to go to the data check right now and do it across equities, bonds, currencies, commodities. Let's flip it here. Katie, commodities, I mean, front and center, I have 87.89 on Brent crude.
I know. It's been a pretty incredible move in the energy market. For a while, it felt like there was one way to go, and it was lower. Again, we do have some important meetings, some important decisions coming out of OPEC when it comes to potentially extending those supply cuts. Obviously going to make a big splash in that market.
Real tight market here, and demand has been effervescent compared to the gloom of a number of months ago. 7:10 Wall Street time this morning with 88.02 on Brent crude, which shows that story into September has some legs to it. In the currency space, I got a churning dollar. I'm sorry, 103.67 on DXY. Nobody expected that 31 days ago. Yen goes 147 into stronger yen, 145. Euro 109 gives it back to 108.33. What do I look at? I look at Euro Swissy, even on Labor Day in America, and that shows me stable Swiss franc. The angst is not there in the foreign exchange market. And as we get to the real yield, this was founded by Jonathan Farrow many, many decades ago. The real yield now picked up because of Farrow's burdens is picked up by Katie Greifeld. You got a 185 in the 10-year real yield. To me, that is the story into the Fed meeting.
It's pretty interesting to see that move. And I remember when we were at extremely deeply negative real yields, there was a lot of ink spilled over what's it going to mean for the equity market when we get back to positive territory. And we're at, what, decade highs and then some right now, and it doesn't seem to be making too much of a dent.
I don't want to slow the show down with how you frame that. Ian Lingen did it yesterday, and he said, I mean, what he said is simple. Price up, yield down by the 10-year yield. That was a market call yesterday from BMO Capital Markets.
What did he say, 3.5%, 3.75?
Price up big time.
Yeah.
Plus, you're going to be in a zero coupon bond. You're going to be the Austrian piece out 97 years and make some real gain on that. Futures up 16. On Jobs Day, we start with the impact on the equity market. Nadia Lovell joins us, senior U.S. equity soft landing strategist at UBS Global Wealth. Nadia, thank you so much for starting us strong in this hour. Soft landing, nobody saw the last 6 days coming in equities, and yet UBS did. Why do you have to be in the market now to participate for capital gain?
You know, we continue to think, I mean, I'll give a nod to John Farrow. We think that we're sort of in this phase of, of bad news is good news again, in the market. And, we've seen some of this play out this past week in terms of some of the disappointing macro data, but still enough to point to our soft landing. We're seeing a repricing in the bond market, and so that's given some reprieve to the equity market. But we don't want that to go on for too long because that will call into question the soft landing scenario. We do think that the market is going to oscillate right here in this sort of narrow range because we do think that peak in the growth momentum is behind us, and we are looking for an economic slowdown, just not a recession. We do think that is going to limit the upside to earnings from here.
Totally unfair off 6 days of analysis, but can you state on 9/1/23 that we have a broadening market?
Yes, I mean, that is our view. We think that the market will broaden out. We continue to favor some of those areas of the market that have lagged year to date, where valuations are more reasonable. We think that you're going to see some churning under the surface, even though we think we're going to be in a range-bound market, where you're going to see some cycling out of those expensive areas of the market. You're already starting to see that in the last 3 months. If you look at the equal weighted index, that's starting to catch up, favoring industrials and energy as part of that.
You see how Nadia Lovell just put me in the timeout chair? She knows I didn't read her note, and she knows Katie Greifeld read her note. Why don't you save us here?
I did read your note, Nadia. I do want to take a detour, though, and talk a little bit about cash. You talk about your allocation to fixed income, but I want to talk about the very shortest end of the yield curve, because you look at the flows into money market funds. We got the updated data yesterday, nearly $5.6 trillion in those money market mutual funds. Do you look at that and say, that's all cash on the sidelines, that belongs to this equity market?
I think it belongs to both the equity market and the fixed income market. What we've been advising clients to do and what we've been doing in portfolios is really extending the duration. We've seen that backup in bond yields over the last couple of months. We didn't think that that was sustainable. And so we actually have been extending duration, favoring the belly of the curve. So we continue to see opportunities in that 5 to 10 year range, particularly in government bonds and high grade investment grade bonds. And so that's what we've been doing, because eventually we do think that bond yields are going to come down. You want to lock in those yields. I mean, we're looking for the 10-year to come down to something with a 3% handle by the end of the year as the economy slow. We're looking for 3.5 to 3.75 range. And then when we look into June of next year, we think that you're going to get to 3 to 3.25 range. So locking in those yields at this point is very important and extending that duration.
Well, walk me through that thought process when you're thinking about the belly, when you're thinking about benchmark 10-year bonds. Is extending duration right now basically a call that basically the Fed is going to cut, or do you see the economic environment turning here and maybe we start talking about a recession?
We don't see a recession in the near term. I would say at the start of the year, we were more in the camp of likely a recession, but the consumer remains strong. And so we think that that can be extended. There are pockets of weakness, but we think that the consumer will remain resilient. So this is more of a call of inflation coming down faster than expected. We're already seeing that in core PCE. If you look at that, that's actually on trend to come down faster than what the Fed has penciled in the June SDP. I mean, the Fed expected like 3.9% by the end of the year. We're only 30 basis points off from that. So we think inflation is going to come down faster, and that would allow the Fed to cut in 2024, and that's what's going to drive bond yields on the long end of the curve lower.
Nadia, we got a jobs report. And so much of it in the angst that's always within the report, even if it's, sub 4% unemployment rate, is a staggering middle class and, people struggling at the low end of the spectrum. And that's witnessed recently with retail. I mean, just to be direct about it, retail craters. Is retail for you, equity retail, XRT and the rest of it, is it a value opportunity now, or is retail a value trap?
I think you have to be selective in retail. We think that there are some value traps in that segment, but there are some opportunities. If you look at the consumer, yes, the lower end consumer has been feeling the pinch for a while, but reality is the consumer is still spending. I mean, we saw that in the Visa credit card data this past week that points to the consumer still spending, but just being choosy, Tom, on where they spend and how they spend their money. If you look at e-commerce, you're seeing continued acceleration in that, as well as cross-border based on the Visa data. So you want to be focused on those companies that have an e-commerce presence and also more in the leisure space than sort of those traditional retailers.
I can't emphasize enough, Katie, how important that insight is. We're not doing buy, hold, sell on Amazon, but this e-commerce partition here is as newsworthy as it was 6 months into the pandemic.
And Nadia, when you extrapolate that forward to retail's basically pricing power, how much is left at this point, and how is that different between an Amazon versus a brick and mortar shop?
We think that the pricing power is dwindling. I mean, you've already seen that even within the consumer product companies have been talking about it throughout the earnings season, that it's becoming tougher to pass along that additional price increase. And so that's something that you have to be mindful of, that the dwindling pricing power, particularly as inflation comes off and the consumer excess savings just get exhausted.
Nadia, John Stolfus, the Uber bull on a couple days ago. Help me out here, Nadia. SPX 5000, 2024?
2024 for June, we're looking for that to get to 4,700.
Oh, you're killing me. Nadia Lovell, thank you so much with UBS there. In the markets. You got to be in the markets, folks, to participate in the game. That's a religion of Gina Martin Adams over at Bloomberg Intelligence and Nadia Lovell over at UBS. I can't emphasize this enough, Katie. And, you think of market timing in Bitcoin. I mean, where did we go to, 66,000? Or something? How many people got out at 60,000?
Oh, if you just look at the chart, it looks like a lot. And they haven't really come back. But yeah, that was November 2021.
Well, this is important. I'm not aware of this. There's not an effervescence right now in Bitcoin with all the headlines going on?
No, it's amazing. If you look at the 5-day chart, for example, we got a big bump after that decision came out in favor of Grayscale over the SEC. Completely given that back. We're below 30,000.
Excuse me, we're 26,065. You can't do Bitcoin round into 5,000. It's not like a Bitcoin bear.
Well, it's just that 30,000 was seen as this key level. And the theme was we got above that. We're going to stay above that. That was not the case.
What are the ramifications here if Bitcoin breaks down through the recent support?
would love to know. Do we start to see whales start selling? Probably not. But when you think about the flush out that we saw of retail after we came off those record highs, if we get back below some of the recent exciting round numbers, then we could see another bit of a flush out.
For the first time in history, Bloomberg surveillance at 8/11/55 Jobs Day, a crypto discussion. Let's save ourselves. The Standard & Poor's 500 up 0.4%. It is Jobs Day. We're going to go beneath the headline data. As I said earlier, non-farm payrolls, the establishment survey is, McKee will be along to translate. He does it better than anyone, literally, in the world, without exaggeration. But I'll be looking at the wage dynamic. I got a 4.4% year-over-year wage gain as a statistic. That doesn't include ECI benefits in that. But if I got a wage gain there and I got inflation supposedly below it, I think a lot of our viewers and listeners say, yeah, right. But the answer is maybe we have a positive real wage in America.
And that's good news if you're a retailer, if you rely on consumer spending. And certainly we haven't seen consumer spending exactly crack here. So all eyes on that wage growth. And as we try to figure out, again, what's consistent with that inflation target that the Fed is sticking to.
We got ISM coming up at 10 a.m. as well. Pharaoh's all over the ISM number. I don't know what that's about. But the answer is they're below 50. It's a diffusion index. And anything set below 50, maybe not German gloom, but the answer is it's pretty gloomy. 47 is one of the key statistics there. That's below 50.
Yeah, hearing diffusion makes me a little bit nervous, but the North Star of 50 is very helpful. I know below 50.
You can even tweak it from there. This is Haverford statistics that we're doing right now.
Yeah.
The central limit theorem at Haverford College. Okay. We got to bid the market, though, critically here, all kidding aside, with 15 minutes to go to that jobs report. The market believes in the American economy. The market believes in revenue and earning. Those levels, 45.33 SPX. We had a 35,000 print on Dow, 34,900. And I can't believe I'm saying that. Am I going to get a NASDAQ of 16,000 in the first days of September? Michael McKee at 8:30. It's Jobs Day.
covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think of myself as a realist, trying to see the world as it really is and not the way I'd like it to be. And sometimes I succeed and sometimes I fail in that.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg.
The Fed, from the very beginning, had a misconception of that this was an ordinary inflation, excess demand, and responded wrongly. Our inflation has come down, but it has nothing to do with the Fed. It has basically because we resolved the supply side problem. We are lucky that Joe Biden got things right. The Fed got things wrong, but the two are going to balance out.
This is important, perfectly timed. Amy, thank you so much for putting the laureate, Joseph Stiglitz of Columbia University, there. And it's a really interesting time to segue here before the jobs report. And this is some of the insight that we hope to give you in Bloomberg surveillance. That is Joseph Stiglitz. And I don't think most people know why he won the Nobel Prize. Someone who does. Katie Greifeld in for Bramo and Farrow, and Sassauer's work from home, or working from, I don't know where Sassauer is.
Still counts.
Getting ready for college football season and all that. But this is really cool to talk to Randy Krosner, one of our great financial economists, of why Stiglitz is Stiglitz. There's Globalization and the Discontents, this hugely successful book with Joe Stiglitz years out in front of a new globalization. Joining us now from Chicago, which is not Columbia, is Krosner, who is not Stiglitz. And yet, Randy Krosner, you know that Sandy Grossman and Joe Stiglitz wrote a paper that you and I have read 6 times. Folks, it's a Nobel laureate paper. It's maybe 6 pages long, and it's got the smallest, simplest equations about, as Alarian says, the unknown unknown. Randy Krosner, why did Joe Stiglitz win the Nobel Prize? What did he say about the information available?
Yeah, it's one of the key things in thinking about how markets work. And as you said, with another Chicago economist, Sandy Grossman, they've thought really deeply about how information is reflected in market prices. And it's really those kinds of insights about how markets gather information from different people, not in the traditional voting booth, but through people buying and selling securities and buying, selling assets, that information is then reflected in the market prices.
Does Grossman Stiglitz, or even the social economics of Gary Becker, does it work in a fragmented America in 2023?
I think it still largely does. I think we see when people have different views of where Tesla is going or where the economy is going, that's then reflected in the prices. Now, they didn't say that everyone gets it right all the time. It's reflecting the information that people have, and people have incomplete information. Boy, and we are in a situation where the Fed and others have certainly have incomplete information.
Well, we're going to get a lot more information in just about 11 minutes or so. And I'm curious, when we think about this jobs report, put it into context for us. Of course, the size and scope here is that it's the final one before we get that September meeting, one of the final ones of 2023. What piece of the puzzle is this in trying to figure out what kind of landing we're heading towards?
So this is very important from the Fed's perspective as well as from the overall economy perspective. We've been seeing a softening of the job market over the last few months. Still a very strong job market. The unemployment rate is at roughly 50-year record lows. But we've been undershooting where markets have been expecting we would be, whereas we had been overshooting for almost basically since the beginning of 2021. So bit of a slowdown there. One of the key things, I think, is thinking about wages, because that's where the Fed is looking at. When it thinks about where's inflation going, it's kind of looking at one of the key inputs, one of the key cost factors, which is wages and overall employment costs. Because even in manufacturing, employment costs are a very high fraction of total costs. And in services, which is the vast majority of the U.S. economy, it's almost all about wages and compensation. And so we really need to think very carefully about that. And I think the Fed's going to be really focused on that piece.
I'm glad you brought that up, because we've been talking about it all morning. The fact, after inflation, after adjusting for inflation, U.S. workers are actually earning something. They're seeing their wages increase here. And when you factor that into inflation, extrapolate that out, how much of a further fuel is that for inflation pressures in this economy?
So it's great that workers are finally getting a real wage boost. That is that their wages are growing faster than inflation. But that's also a bit of a challenge for the Fed, because they want to bring inflation down. And if one of the biggest cost factors is now growing faster than overall inflation, that's a bit of a challenge. Also, I think that will affect the demand for labor. Because when real wages have been negative, or when real wage growth has been negative, firms really want to hire people because they're relatively cheap. Now they've become relatively expensive, and I think that's also going to be a factor that will be weighing on the job market going forward.
Randy Krosner with Joe Stiglitz talking to Francine Lacroix in Italy. We can go back to the oddity of Gary, Indiana, giving us Joe Stiglitz and Paul Samuelson. Amazing, 23 miles from your University of Chicago.
Mm-hmm.
The poverty is painful. It is heartbreaking in Gary, Indiana. What is your policy prescription to help the poorest of poor people in America on this Jobs Day? Or if we move beyond that where there's no help, it is a welfare state?
Oh, no. I think there's certainly lots of things that can be done. And so I think, one, making sure that we have strong labor market and strong overall economic growth is super important. Also, inflation tends to hit people at the lower end of the spectrum much harder than people at the higher end of the spectrum. People at the lower end of the spectrum tend to hold more of their total wealth in cash or deposits. And most people have been earning almost nothing on that as inflation has been going up a lot. And so trying to bring inflation down is also going to be something that'll help these guys.
Randy Krosner, John from Monza, that would be Pharaoh on vacation. He's over at Formula One in Italy. Randy, John says, get back to the chat of the Federal Reserve. Can this jobs report today actually shift a Federal Reserve as they go to the September meeting? I don't buy it.
Unlikely, but if it's an extreme report, for sure, it could. So if we see, a real blowout jobs number, we see the wage number going up very dramatically, that's going to increase the likelihood that the Fed will act in September. If we see a report that's sort of in the range of what we're expecting, the wage growth continuing to be 4% or so, we see job growth in the 150 to 200,000 range, then they're more likely to pause and see where things go.
And I'm looking through your notes from August 4th, about a month ago. You write that the Fed got a gift. The inflation rate is coming down and the unemployment rate is not going up significantly. They would like to preserve this, no question. Is that sustainable?
Well, this is the great question about whether we can have the immaculate disinflation. That is, we can bring inflation down without the unemployment rate going up substantially. It's never happened before, and I never say never about anything, having lived through the global financial crisis at the Fed. But I do think that it's going to be difficult to bring the inflation rate down in a sustainable way without the unemployment rate at least moving up somewhat from where we are here, because there's still a lot of wage pressure that's there. And as we were talking about before, if one of the major cost factors for both services and manufacturing is going up at 4%, it's going to be very difficult to make sure that overall prices only go up at around 2%.
Professor Krosner will stay with us, folks, as we are 5 minutes away from this jobs report, as he always does. Jeffrey Rosenberg scheduled to be with us as well. Let's do a data check here. The dynamic, there's a pulse to the market. You see it with the red and green blinking on the Bloomberg screen, but I don't want to oversell it. Futures with that 4-day lift up 16. Dow futures up 121. The VIX 13.47 really says it all. Katie, even the real yield, as you go to it this afternoon with your show, the real yield gives way back to a 1.85. It's been a lower real yield the last number of days.
Absolutely, and you can see that expressed in the nominal. I mean, the fact that we were eyeing 440 earlier in August feels like a far way away right now.
Some people talking about an 8% mortgage rate. We're not there, but the bank rate, 30-year mortgage, affects the housing economy of America. Again, 4 minutes away here from the jobs report, always a mystery with the leadership of Michael McKee. We'll go beneath the headline data. On radio, on television, across America, this is Bloomberg's Surveillance.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
Jobs Day in America. John Farrell, Lisa Abramowitz, well-earned vacations. Lisa's north of Tupper Lake. Farrell, almost a Monza there for the qualies tomorrow at Formula One. Katie Greifeld in for Lisa Abramowitz and John Farrell with our usual lineup of brilliance to give you perspective on the American labor economy. The lift here is futures up 17, the VIX 13.48. It is morning in America. It's always Jobs Day morning for Michael McKee, who gives us wisdom right now.
Well, the received wisdom here is things are a little bit better than expected. 187,000 jobs created during the month of August. That is exactly the same as the prior month. I'm waiting for the revisions to drop here because I don't think, here we go, 187,000. Wow. The unemployment rate, though, rises to 3.8%. Check that box for the Federal Reserve, I guess. We'll check on the non-farm payrolls revision in just a second. The change in manufacturing payrolls is big, 16,000. That was presaged in the ADP report, but it's kind of odd given the stories we've seen about manufacturing these days. Average hourly earnings come in much lower than anticipated, 0.2 increase after 0.4 last month, and on a year-over-year basis, that pushes us down to 4.3%. Now, that was what was expected. Labor force participation rate rises 62.8, which is kind of interesting. So a lot of underlying details here I'm going to want to check. The July number for the total payrolls is 157,000 after revisions, significantly lower, which means that we had a rise to the same level that we had last month. But that means probably a revision to August will be coming. Change in private payrolls, 155,000. That was initially reported as 172,000. It's 179,000 today. So 2 months the revision, 110,000. Thank you to Bob in Connecticut for pointing that out to me. And it looks like this is the kind of report that will keep the Fed sidelined in
November. Come on, Mike.
September.
November.
I'm not going to go there, and I'm not going to go to November yet because anything can happen. And I want to look into the details because there's a lot of threads to pull on this report.
Now, you go deeper into those two reports here with Randall Krosner coming up in moments. Right now on the market check, it is Fed friendly towards a pause. I was busting Mike's chops about November. You know what? The market says pause in November. Futures advance up 26 on the Standard & Poor's 500 futures. Dow futures launch 150.2. The VIX comes in nicely. That's a key signal. The VIX 13.28. Could you imagine a 12 VIX to set up your Labor Day weekend? In the bond market, Katie Greifeld, help me here. In 5 solid basis points, 4.06 there. And the real yield, moving to your show this afternoon, a 182 real yield speaks volumes.
We just got a lot to to talk about at 1 p.m. Eastern, but let's look at the 2-year yield right now, plunging down 10 basis points at one point. That seems to be, if you look across markets, where the most dramatic move is.
We're going to keep those shots up. For those of you on radio, it is a real adjustment off this jobs report. You see it with weaker dollar as well, suggesting a lower rate regime across America. You see it with yen coming in solidly, 144.88. To Mike McKee, for a couple observations, can you say this is strike-induced? Are the actors and the screenwriters and vet bills off on strike, SAG and that? Can you plug in an L.A. entertainment strike to give us these gloomy numbers?
I give you a bigger one. And that is the Yellow Trucking Company going out of business. According to the Bureau of Labor Statistics, that cost about 30,000 jobs during the month. And that, if you add those back in, then you would have a much more significant jobs gain than what we've seen. The other thing that stands out is that we have had a decline in state and local education, a significant decline in that, which is a seasonal adjustment issue, because of course August is when everybody goes back to school and the teachers should be on the job, so it's pushing down that number and maybe artificially low.
Before we get to Professor Krosner, Michael McKee, you mentioned this as you always do, the wage dynamic. You've told me, he schooled me, folks, year over year is for old fossils like me. Month over month is where the cool people like Mike McKee are. The month over month hourly earnings number from a 0.4 to 0.2, that's substantial, isn't it?
It is, and it does suggest that wage gains are slowing down. Now, interesting that the people in the trucking industry and the people in manufacturing who might be on strike coming up, those are higher paid jobs, so they would influence the overall number. We did see a big increase, as we have almost every month, in leisure and hospitality, about 40,000 jobs added there. Construction is kind of interesting because 22,000 additional jobs at a time when people say we can't find construction workers, and when home builders are putting homes in the ground as fast as you can do. The truckers actually lost 37,000 jobs, not just 30,000 jobs. So that was a significant headwind for these numbers.
Before we get to Krosner, Mike, I got to slip in one more question as you dive towards the 9 o'clock hour. We'll have a lot more perspective here. AMC says Miss Swift, her concert film breaks advanced sales records. You've been doing this for years. Can you tell me two entertainers, Taylor Swift and Beyonce, can move the needle on American GDP?
No, I'm not going to. I'm an outlier on that. The amount of money that they have generated is substantial, but it is a drop in the bucket compared to a $24 trillion economy. A couple of economists said that the Taylor Swift tour would add to August employment. I don't know how they would be thinking that. The tour began on March 27th and ended on August 9th. So you would think any Taylor Swift employment would have been accounted for.
And you've seen how many? You've seen 3 shows?
Yeah, and I'm actually getting ready to go to Europe and follow her around.
Yeah, I saw a $700 ticket in Lyon. You look in Paris, and $900 for her.
I might go to the movie just to see what everybody's talking about.
McKee's going to dive into this data, folks. It is a lift to the market. Standard & Poor's 500 futures up 0.6%, as well as a nice NASDAQ lift as well. Randall Krosner with perspective here, and we've got to forget about the economic mumbo-jumbo and go to the Fed. Professor Krosner, can you glean here a Fed that will change its attitude towards the November meeting?
So I think, as we were talking about before, this is kind of roughly what the Fed was expecting. You've seen a little bit less wage pressure, which is good from the Fed's perspective. We've seen greater labor force participation, which the Fed also likes. That's likely what is accounting for the increase in the unemployment rate. So you're seeing the kind of Goldilocks scenario that the Fed wants, that the labor market is gradually softening, but not cratering. It's taking some of the pressure off, and so that'll take the pressure off the Fed from raising rates. I think it'd be really unlikely that they're going to move in at the next meeting. And obviously, there's going to be a lot more data that'll come out between now and then. But unless there's some major surprise, they're probably likely going to hold through the rest of the year.
Randy, we've got to run, but one more quick question, if I may. It's a dual mandate. Is it really a dual mandate for this Federal Reserve System?
Well, this is the big pivot that came last year at Jackson Hole when Jay Powell said, there's one thing that we're going to do, and he said it 8 times, that we're going to fight inflation. So he basically said, sure, we have a dual mandate, but the inflation part is the most important. This year was kind of more back to normal, that we have to worry about both the inflation part as well as the employment part. And so that's why the Fed's looking so carefully at the data to make sure that they don't raise rates so much that they bring the unemployment rate zooming up.
Right.
It's hard to get that perfect. A lot of people think, oh, the Fed can perfectly engineer this soft landing, that they have so much control that they can move the unemployment rate up just 1 or 2 tenths of a percent and leave it there. It's not so easy as that. There are a lot of other factors that come in.
Governor Krosner, thank you so much for joining us today. Professor Krosner at the Booth School in Chicago. Katie, why don't you bring in Jeffrey Rosenberg here? It's a bond market shifting.
Well, let's do it. Jeff Rosenberg, he is portfolio manager of the Systematic Multi-Strategy Fund over at BlackRock. Jeff, it's great to talk to you. You look at the first blush reaction in the markets. You have short end yields absolutely plunging. You have futures getting a bit of a bid. When you go through these numbers, is that the correct reaction?
I think it is, and I think this was the report that the market was looking for. You might have had a bigger reaction if it was a stronger than expected report, but this is the reaction of pricing out the last hike that the Fed suggested they might have to deliver. You know, and so I think that market reaction makes a lot of sense. The front end of the curve, both in reals and nominals, is where you're seeing the biggest reaction, and that prices in the near-term expectations for Fed policy. So the labor markets are normalizing, and that's the main message from today's payroll report. Wages are softening a little bit on the margin, not really much movement in the 3-month averages. The 0.2, it just missed rounding up to 0.3. It's a 0.24. So you're seeing still the slowness in the last piece of the puzzle here, which is the slowdown in the wages. And so the Fed's going to still talk about that. But when you look at labor force participation, that's a big change. That's what the Fed wants to see. As Randy said, that's the reason for the increase in the unemployment rate. But as we saw earlier in the JOLTS data, this is exactly what the Fed is looking for in terms of getting the normalization in the labor market, seeing that reduction in the vacancies to unemployment coming through the vacancies, less from the pain in the unemployment. And that's a good outlook for the market. And that's why you see the equity and the risky side also positively responding here. So pretty much a very nice number for everyone to go into their last holiday weekend. Yes.
And Jeff, you talk about the labor market normalizing here. Extrapolate this into Fed policy, because at a certain point, the Fed is going to have to cut interest rates just to bring rates back to more normal, neutral levels. Does this report push those rates further into the future, or does it bring them forward?
Well, you know, it's a really important point, which you just highlighted, about the need to be cutting interest rates, not necessarily to bring them to more normal levels, but go back to Powell's speech last week. It's about restrictive policy for longer, not higher for longer. And so as inflation falls, and that's really about the wage inflation picture from today's report, the Fed has to cut rates to avoid the real interest rate from increasing. And that's really what the bond market has priced in for next year. The gradual decline in inflation leading the Fed to have to cut rates, not because it's a hard landing or because they're cutting rates because they're overly tight, but they're cutting rates to avoid becoming overly tight, to maintain restrictiveness. And I think today's report just feeds into that market consensus and that market expectation.
Hey, Jeff, I find this absolutely extraordinary, which is we had a failure of transitory, and then dare I say, and granted, there's an ambiguity here, folks, if we actually get price up, yield down, but we're almost back to a successful victory lap for the Fed. Do you agree that this is a Fed on the edge of a victory lap?
Well, I think one thing we have to be a bit careful about, Tom, is that we've certainly seen the victory from these very aggressive, very historically distorted levels of inflation due to the COVID supply side shock.
Yeah.
that's very different than claiming victory, that the damage that had occurred as a result of those policies, as a result of the fiscal and monetary policy overstimulus, has completely been wrung out. And so that's about the victory from 3% to 2%. You remember from last week, Powell, one of the main takeaways, two main takeaways were data dependence, yes, but the other big one was we are not abandoning, the Fed said, Powell said, we are not abandoning the 2% inflation target.
Right.
A lot of discussion around, hey, just accept 3%, it'll be okay. So I think before you can claim victory and do the victory lap, we really are going to be talking about what does it take to get you from 3 to 2? What's the cost versus the benefit of just leaving it at a higher rate?
And now pre-Labor Day, Carnegie Mellon Math. We're going to do this with Jeffrey Rosenberg. Come on, Jason Furman's out doing this correctly, Jeff, talking about the ecumenical PCE index. And you know, Jeff Rosenberg, it's how you pick your duration of the vector. Are you looking at a 1-year annualized or a 6-month annualized, or what I do, which is a 90-day annualized, 3-month annualized vector for inflation? What is the rapidity of the decline in inflation right now?
So on the headline and even on the core, you're seeing, good progress. And to the part of the question, it's much more relevant to look at kind of the near-term numbers, annualizing what is that pace of decline. But it's really about this core measure that Powell talks about in terms of services, less housing, that really gets to, again, the wage inflation picture that feeds into the more durable aspects of inflation outside of the commodity and goods sector, which is deflating because of the supply side improvement. What has been very supportive over the last 3 months is that 3-month level of core inflation has been declining. And so it's feeding into this soft landing on inflation narrative. It's still a slow pace, and I think that's what you see in today's wage number, but it is going in the right direction. You brought up the equity market. That's positive for the equity market. So everything is looking like it's moving in the right directions. It's still a bit slow, but certainly the labor market normalization story got a boost from today's report.
I want to bring this conversation more firmly to the markets. Ian Lingen was on surveillance a couple of days ago of BMO, calling the 10-year Treasury a screaming buy. I think that made multiple headlines. When you look at this report and the totality of data that we've gotten in the past couple of months, do you think now is the time to really step forcefully into duration?
Well, when we talk about duration, it's not so much how much duration you hold, but where in terms of the maturity spectrum you hold that duration. So I think that the screaming buy is the 2-year. Thank you for bringing it up, because I think there you have the best combination of yield and the exposure, as we're seeing in today's market reaction to changes in this kind of normalization. That is the part of the yield curve where I think you're going to have the best risk reward in terms of owning duration. When you start talking about the long end, now you got to start considering whether or not the term premium, the long-term inflation premium, whether the long-term real interest rate is really priced appropriately. And I think there's a lot of questions about whether this post-COVID, post-normalization yield curve at historic levels of inversion is really where you want to be concentrating your duration in the long end exposure. I think there's much more vulnerability in the long end, given that degree of inversion, which basically says you're not getting paid in terms of the yield for those fundamental factors, which all could be increasing in this post-COVID environment.
Jeff, thank you. Jeff Rosenberg is with BlackRock there. Great perspective with the bond market on the move, a solid 7 basis point move. That's a big move for those keeping score at home. On the 2-year yield, 4.79%. Futures up 0.6%, up 26 points. NASDAQ giving me the same 0.6%. Look, and the VIX on a tear, 13.29. Got a number of ways to go here, but what I know is he's piling into pages of data from labor, from BEA, from census, and the other 7 organizations on Jobs Day. What's a singular McKee insight right now?
We also checked your grocery list, Tom. 736,000 people entered the labor force during the month of August, a huge figure. And that's why we saw the unemployment rate go up, because 222,000 of them got jobs, but 514,000 didn't. Now, this is good news in a way for the Fed. They've been expecting the unemployment rate to rise, and it did, and they also expected the labor market to loosen, and obviously it has loosened in the month of August, so it tells them some good news. The other thing to look at here is that we did see a rise in unemployment for whites to 3.4% from 3.1%, but black unemployment went down to 5.3% from 5.8%. That had reversed a couple of months ago and gone way up. So that is better news as well, because there's always the fear that, last hired, first fired, et cetera.
We got to go quickly here, but is there a big difference between 3.9% unemployment and 4.0% unemployment?
Not
psychologically, is there a big difference?
I don't know whether American people would think that. As long as they have jobs, they're probably less concerned with the headline number. But it is the Fed that's looking at it. And remember, they forecast 4.1 by the end of the year, and everybody thought they were going to have to change that because it was going to be too high, rather. Now, maybe it's within reach.
We dash to Ira Jersey now, Chief U.S. Interest Rate Strategist, Bloomberg Intelligence here on bonds. Ira, are mortgage rates going to come down off all this good news?
Very little bit here. The long end is already priced for the Federal Reserve at some point to cut interest rates, a modest amount. It's really, I'm focused more on that front end and how the market is interpreting this data in terms of not only a November hike and the probabilities of that, but more importantly, the Fed being on hold for even longer than maybe people thought. So we're still in this environment where the market is going to remain inverted for a long time, but this data has to be pleasing to the Fed, and I think means that you can have two-year yields that will remain below 5%, at least for a little while.
Feels like we're well below 5% at this point. Your two-year Treasury yield below 4.80. And Ira, on your point on the curve that we're going to remain inverted for a long time, where is that pressure going to come from? What end of the curve basically is going to be driving that dynamic?
Well, I think the long end of the curve, the 10-year, the 30-year, will probably hover basically where it is now, say a little bit, 4%, 4.10, 3.80, something like that. But it's really going to be that two-year yield that's going to drive the shape of the curve going forward. Just like it did when we got to negative 100 basis points on the 2-10s curve, that was because twos were up above 5%. Now that we're down and likely to trend a little bit lower over time, you'll start to see an uninversion of the curve. But I think that process is going to be relatively slow, particularly because today's data is almost Goldilocks in a way, because you still have an environment where you're growing jobs, but in the inflation components of this data is slowing. When you look at the wage data, for example, then that just means that the Fed can remain on hold, just like Jay Powell's been talking about, well into 2024, if not to late 2024, assuming we don't start to get negative job prints.
And Ira, I want to stay on levels here since we've seen some pretty amazing moves in the bond market over the past month. If two-year yields are probably going to stay below 5% for some time here, you look at the benchmark 10-year Treasury yield, where is equilibrium right now?
Well, so that depends on what model we use for fair value. So we have some models that say we're pretty close to fair value now, but our fundamental model suggests that we should actually be a bit lower in yield, closer to 3.6, 3.7%. So I think that the risk here is that we can rally a little bit, particularly if we have some softness and things like the equity market, where I think the path of least resistance is going to be toward somewhat lower yields as opposed to higher.
Ira, if the 10-year real yield breaks down, what is the ramification of that? There's a technical level. Ian Lingland brought this up yesterday. But if you get, with a 10-year real yield, 1.85%, I don't know where the breakdown is on support. But what happens? What's the so what if the real yield walks away from 2%?
Well, I think some of that's the fear of missing out, right? Because if we are truly in a different inflation regime than we've been in the last couple of decades, then people should like real yields, right? Like being able to buy tips and being able to get some inflation compensation on top of this, a positive real yield. Remember, we spent a very long time with real yields being negative and quite substantially negative for a very long time. So tips in some ways I think are pretty attractive at these kind of levels. And keep in mind, like when we talk about the rate moves that we've seen over the last month, it hasn't been inflation expectations that's been moving. It's been real yields. And the way that we look at real yields, there's basically two major things that affect them. One is liquidity and volatility of the Treasury market. Obviously, we've had a lot of that. But importantly, it's also expectations for policy rates. And if policy rate is that the policy rate's going to be going down at some point in the future, then you'd expect real yields also to follow that. Will we get to zero or negative? I don't think so this cycle, but we could certainly rally.
Thank you so much with Bloomberg Intelligence. Because of time, with futures up 25 right now on SPX, we get to the equity markets off of this shocking jobs report. Sarah Hunt joins us, Chief Market Strategist, Alpine Saxon Woods. Sarah, it's real simple. I've got an 11.8% Standard & Poor's 500 return over the last decade. I got a lineup of people with fear. How do you push away the fear into September, into the fourth quarter, given this economic data and a successful Fed soft landing?
Well, good morning, Tom, and thank you for having me. I think this is really an interesting report, especially since we revised last month negative. And I think that this is, I feel like Ira Jersey stole my Goldilocks moment. I was going to say that's a Goldilocks number because you've got all the components working in the direction that the Fed wanted to go. Remember, we were looking for, on some of the summary of economic projections, 4.5% unemployment by the end of the year, and it's been staying so steady that that number looked unachievable. 3.8 is not 4.5, but directionally, that's what the Fed was looking for. I also think that the softening in wage gains is also something that the Fed was looking for. The interesting thing is about the number of people who have come back into the labor force, and you have to wonder if some combination of the fact that that pandemic surplus is being spent down, student loans are coming back, may be part of what is shifting the labor force, because the question has been whether or not it's structural to have so many fewer workers, or it's possible that so many people didn't have to go look for a job, and all of a sudden they're staring down what is not as rosy an economic picture without as much of a savings backdrop.
And Sarah, like you said, this is good news for the Fed. That seems to be the narrative in markets right now. But how noisy is this data? You look at some of the specifics from the BLS. Film industry payrolls fell by 17,000. Then you take a look at trucking payrolls, fell by 37,000. How much of a piece of the conversation will some of those nuances be?
Well, I think this also goes to one of your earlier guests this morning was talking about the fact that the economy is rolling in cycles and nothing is moving at the same time. Historically, in a recession, everything goes down and then everything comes back at once. And we've been through such an odd period of time during this pandemic where you've had rolling recessions in some sectors and not in others. And I think that those labor numbers just speak to that you've got different places where you're experiencing either a boom in labor or a slowdown. And I think that the labor hoarding that's going on is probably slowing down as companies are getting a little bit harder. It's harder for them to push price a little bit in this environment. So I think that that's where you're going to start to see movement, where you pretty much have not seen a lot of movement year to date.
Sarah Hunt, in the market, in what is a bull market with a VIX of 13.29. Sarah Hunt is with Alpine Saxon Woods. Michael McKee is in the triple leveraged all cash fund. He and I have missed this great bull market. So we have to keep working.
We have to keep
Labor
working.
Day.
And
No days off.
I've been looking at some more numbers, and I want to give you one more number in honor of the lady sitting between us. People with two jobs.
Okay.
Since she's also anchoring the afternoon shows, rose by 300 during the month. So you consider yourself special because
we're temporary workers right now.
Temporary workers. The number went down a little bit, I believe, but it is. It has not been a major impact on the numbers lately.
It's interesting. I mean, I'm absolutely fascinated now how we stagger to the inflation report. I can't remember when it is, September 12th, whatever the coming up. But the inflation report coming up, Michael, has to have an even greater weight after this is this Goldilocks report, as Ira Jersey and Sarah Hunt put it.
Well, it does. It would have to be bad for the Fed to probably go in September. Again, I'm not going to touch November because there's a lot of numbers between now and November, and everything could change.
I mean, I'm looking at futures up 23, Dow futures up 138. It's just going to be fascinating to see. And on the real yield, Katie Greifeld, I mean, you know, we make jokes about it, but I'm sorry. That number Ira Jersey spoke of a real yield down to 1.3% is game-changing.
Game-changing.
And very different from Europe. I mean, polar extreme from the discussion in Europe right
And not just for the bond market either. You think about the read-through into some of these risk assets that we talk about all the time, into corporate credit, where that real yield goes is very consequential.
Can you do something about the 30-year bank rate mortgage?
I don't think if I could, I would.
Can we, you know, call Labor Day weekend, like, you know, the end of the idiocy in the housing market?
I don't know. It doesn't seem like buyers or sellers are having a great time right now.
Technically, it is brutal. I mean, above a 7.5% level. I mean, and some really interesting work going on right now. I really want to summarize this. I mentioned Professor Furman at Harvard University talking here about how you measure the inflation rate across a 1-year annualized, 6 months, 3 month, and that. But the other thing you need to talk about is just simply disinflation and where the outcome is in 2024. And there's a huge divide between Andrew Hollenhorst of Citigroup, say, and what we see from Edward Hyman at Evercore ISI.
Absolutely. And where this jobs report moves us on that narrative, maybe a win for the disinflation count.
Help me here with the mortgage market. The 2-year yield, as Jeff Rosenberg says, craters 8 basis points lower yield. The 30-year bond is a proxy for that. Mortgage goes up.
Yeah.
The yield went up here on jobs day 30-year. No house hunting this weekend. Thank you to our team for a spirited Friday Labor Day report. Stay with us. This is Bloomberg.
From New York City, for our viewers worldwide, I'm Alex Steele in for Jonathan Farrow. Guess what? Good labor news is actually good news for the market and a bull steepening in the curve. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Farrow.
U.S. payrolls topping estimates while wage growth starts to cool, lifting futures higher, sending Treasury yields lower as the market prices out a final rate hike for this cycle. We begin with the big issue, payrolls in America.
We're watching the labor market.
The payrolls number, non-farm payrolls.
The relevance of non-farm payrolls on Friday simply can't be overstated.
The key data point we have to be watching is the labor market and specifically wages.
If you look at the economic data, I mean, it just keeps coming in, showing a tight labor market.
A very strong, tight labor market.
We're starting to hear a little bit more in terms of softer employment.
We already know that the job market is slowing.
Jobs are cooling.
Cooling off a little bit. I think that the Fed's got to be quite encouraged by that.
That may get the attention of the Fed.
The question is this the data point that Fed needs to get near the end of the tightening cycle?
We're going to have to try to read what the underlying trend is in data.
I think that the jury's still out as to the ultimate direction of the economy and labor, for that matter.
Follow the labor market.
Labor is key as we head into Labor Day.
Joining me now to discuss, BlackRock's Rick Reeder. Rick, I was super pumped. I get to talk to you. It's been way too long.
Hey, Alex. Yeah, I agree. I thought the same.
Good to see you. Hey, what's your reaction? The market's taking it as a Goldilocks report. What do you think?
It's a good report. I mean, if you're the Federal Reserve, it's a pretty good report. I mean, you're starting to not just, in fact, the unemployment rate's ticking up a little bit, but it's ticking up for the right reasons, that you're getting this significant 736,000 people entering the labor force. I think Mike McKee pointed out. But, you know, it's interesting when you actually dissect it further, you're seeing some things. The cyclical parts of employment are clearly softening. You know, I saw transportation, temporary hiring is down again this month. But, you know, you see things like healthcare and education, which are not cyclical, continue to have a firm tone to over 100,000 jobs again. So, you know, listen, I think it's pretty good. It is, and obviously wages coming down is significant. Listen, I think you can use this as another benchmark for the fact that we're seeing slack build in the labor force. We're seeing employment what has been an unbelievably hot employment market, labor market, is coming off a bit alongside of inflation coming down. So pretty constructive.
Yeah, that is a really articulate way of saying Goldilocks. Hang tight, Rick. Let's get into the details. Michael McKee joining us with the latest on the payrolls. Mike, you're digging through. What do you have?
Well, Alex, the initial print looked pretty good, 187,000, but that comes after 110,000 were subtracted from the month before, leaving July at 157. So it isn't as strong in terms of job growth. The net revisions of 110,000 down. Unemployment rises. And skip over hourly earnings for just a second and look at the labor force change. That's why unemployment rose 736,000, as Rick was just mentioning, after 152,000. Fed's been waiting for that to happen, people to come back into the labor force and help push unemployment up, and that is what we saw. But we did see wages not rise as much on a sequential basis, up 0.2% after a 0.4 the month of July, and that pushes down the year over year. The Fed is going to be happy that we're seeing a little bit of slowing in wage growth. Now, the numbers relatively weak, I said, but take a look at why. One of the reasons that we have seen a big drop is that the Yellow Company went out of business, and 37,000 trucking jobs were lost. You can see the drop there. If you add the 37,000 into the 187, you'd be well over 200,000, and that would be reasonably good news, or bad news, depending on how you want to look at it. Where the jobs aren't also shows us something. Motion picture and sound recording. This is the SAG after strike, subtracted 16,800 jobs, almost 17,000 jobs. State and local education, teachers go back. Everybody goes back in August, but they didn't, according to this. So there's a seasonal adjustment issue. Leisure and hospitality still gaining a lot of jobs, and construction, surprisingly, even though it's busy out there for new home builders, construction jobs up 22,000. They found people who could do the work. So good news for home builders, but it also suggests that we have sort of this Goldilocks report where you've got some good, some bad, rising unemployment rate, lowering earnings, and the Fed's going to like that.
Mike, great breakdown. Really appreciate that. Atlanta Fed President Raphael Bostic making the case for some patience, saying today that based on current dynamics in the macro economy, I feel the policy is appropriately restrictive. I think we should be cautious and patient and let the restrictive policy continue to influence the economy, lest we risk tightening too much and inflicting unnecessary pain. Hey, Rick, does that equal we're going to pause in September and then TBD November?
I mean, I think so. I mean, I think the Fed should be done. I certainly think, given this number, unless you got something very significant on CPI, I think they're not going in September. Listen, I think when you dig in, and there's something that's really important, and this number embodies that. You know, why do 736,000 people come back in the labor force? The lower income strata in this country are having a tougher time.
Yeah.
You see that in terms of, you know, by the way, look at the earnings reports from the Dollar Generals, et cetera. The lower income strata is having a tougher go. You see credit card balances rise. Listen, I just think we're seeing, you know, when you lift rates this much, you benefit the higher income, who are the savers, and you hurt the borrowers. I think Tom Keene was saying, you know, look at where mortgage rates are. I think the Fed should stop.
Okay.
And I think we're at a place, and today certainly gives them further information or justification for that.
So, Rick, do you buy the front end on that?
I mean, you know, we like the front end of the curve, and you know, we've been talking about on TV for a while. We like holding, you know, the front end. I mean, you get paid if you buy CP, et cetera. You get paid 6%. It's been incredible, or about cheap as 6%. It's incredible carry. But I think now that you can actually extend that a bit further on the curve. You know, we talked about, I think, last month, and we've been adding some out to the belly of the curve because you're pricing in, if you believe the Fed is done, and you're not paying a lot for the forwards because the markets have priced out a lot of those cuts, that you can actually extend a bit further out the curve today, lock in some of these yields, not just in treasuries, but in parts of the credit market, mortgage market, securitization market. So I think you can put your shoulder behind a bit more of interest rate exposure than and has been the case certainly over the last few months.
So what do you do with the long end? Where's going to be the top, say, then for the 10-year?
Not a lot is to in terms of what do you do with it. Like, I mean, I think the very back end of the curve, unless you're a pension fund, a life insurance company with an inverted yield curve, it's not a hedge to risk, because if inflation is higher, it's going to hit risk and the back end of the curve. I don't think there's a lot to do with it. And like you say, unless you're defeasing or you're matching a liability as a pension or life insurance company. So I think listen, I think hiding, and it's not hiding, clipping an awful lot of yield in the front to the belly of the curve makes sense. The 10-year is sort of, do I think rates can move a bit higher from where they are in the 10-year point? I still think they can go a bit higher. They strike me. Do you have some interest rate exposure out to the 10-year? Maybe. Like I said, I don't really like going further than that, but I certainly prefer being in the front to the belly and just holding that carry.
When do you want to buy the 10-year, Rick? Like, are we looking at 4.5? Like, at what point you're like, okay, I'll pull the trigger?
So, by the way, I mean, owning some, I would say buying some recently. Owning some 10-year notes is not crazy. And could you go to 4.25, 4.5? It's certainly a possibility. When do you want to grab more duration, more interest rate exposure? When you think the Fed is now shifting into more of a easing cycle. Listen, maybe when you parse what Chair Powell said at Jackson Hole, he gave a lot of data for what would cause him to hike rates. They're still in a mode of inflation above target, and we're certainly not in a mode of it's time to ease, even when you, as you say, Bostic's comments about it's time to pause, which I agree with. But they're not at a place where it's time to ease. When that starts to manifest itself, gosh, do you grab for more duration further out the curve and other parts of the curve? I think so. Again, the one point I would make, when they do that, the yield curve is going to steepen. So this is part of this idea, like, do you need to go, how much duration you have to have far out the curve? But adding some interest rate exposure, definitely.
So I'm looking at WIRP, Rick, and it looks like May. We're still pricing in May for that first cut. Is that in line with how you guys are thinking about it?
Yeah, I mean, I still think you have to consider that the second half of the year may get to, I guess, close enough. But I still think it's the second half of the year. I think this Fed would like to see a persistence of inflation under target. They'd like to see some more slack in the labor force to give a sense that you've really bolted down the durability of lower wages, lower inflation. And I think that takes a number of months to get that for them to feel really good about that data. So I think we're like part of why I like taking a bit more interest rate exposure. When you get to May, June, July, et cetera, now you're getting in a place where you have enough data to build your confidence set. And so yeah. I think that's about right at this point.
Hey, Rick, I don't want to open like a ginormous can of worms, but is it the same narrative when it comes to Europe?
That is a Janet. So
you got 30 seconds. No, I'm kidding.
Europe is really different. Europe, you're still well above the inflation target, and growth is challenging. You look at the data in Germany. That is, I mean, boy, it's some of that's a derivative of the impact from China. You see that through manufacturing. Now, by the way, you look at the UK. Looked at the housing data today in the UK. Europe is slowing. I think that you'll start to see these inflation numbers start to fall, but they're still well above what is a normalized inflation in Europe. So, how you think about your interest rate exposure in Europe and where on the curve you hold it has to be a slightly different set of expressions than you would do in the U.S. because it's a very different economic paradigm relative to inflation.
Yep, it's not synchronous anymore in that respect. Hey, Rick, really good to catch up with you. Thank you for joining. Rick Reeder joining us from BlackRock. All right, let's take a look at some of the stocks ahead on the opening bell. Simone Foxman joins us now. Simone?
Yeah, Alex, set aside some of the impact of those job numbers. We got a really strong slate of earnings out after the bell yesterday from some tech companies. Dell beating its expectations, boosted by its AI server business, especially the partnership that it has with chipmaker NVIDIA. PC sales also better than expected. COO Jeff Clark encouraged by the macro environment, especially in June and July. MongoDB, the database software company, shares rallying 4.6% in the pre-market after EPS came in really double the expectation. A beat and a raise there. And finally, a beat and a raise for Lululemon. High-end consumer is strong. We're seeing shares rally as Stifel, JP Morgan, BMO, all lifting their price targets.
Yeah, you buy the yoga pants, but apparently not Dollar General. All right, Simone, thanks a lot. Coming up, the U.S. payrolls report taking some pressure off the Fed.
The labor market holds the key to whether you can pull off that soft landing. So continuing to see businesses add jobs, that's helping in terms of consumers' income and therefore their own spending, while giving time for some of those supply side issues from the pandemic to unwind. And I think the labor supply story is very much a part of that.
More on the latest jobs report with iCapital's Anastasia Amoroso and PGIM's Michael Collins. That conversation next. This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
This is Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
I think you can use this as another benchmark for the fact that we're seeing slack build in the labor force. We're seeing employment, what has been an unbelievably hot employment market, labor market, is coming off a bit alongside of inflation coming down.
The U.S. economy adding more jobs than expected in August. Non-farm payrolls coming in at 187,000. Unemployment rate rising to 3.8%. Wage growth cooling, underscoring a strong labor market that is coming into balance. iCapital's Anastasia Amoroso and PGIM's Mike Collins joins me now. Mike, let me just start with you because Rick Rieder, that was his take on the jobs number, and then he's like, let's go buy the front end, right? Is good news finally good news here?
Yeah, I think a slowing labor market, which has been in place really for most of the year now, is good news. The unemployment rate finally, that stubbornly low unemployment rate finally ticking up, I think is good news, but you have to be careful, right? The labor market can be a real slippery slope. Once it starts deteriorating, Alex, sometimes it deteriorates too fast. So you have to watch what you wish for, but we're definitely in that, weakflation, slower growth, moderating inflation camp, and that's good for risk assets.
All right, Anastasia, do you agree? Good news, good news?
I do. I think this is a very welcome jobs report, Alex, because, I like seeing the labor force participation rate tick higher because the Fed has been trying to solve this supply of labor issue as part of the labor market rebalancing. So the fact that tick higher is really good news. And the unemployment rate, of course, is 3.8%. So on the surface, that's a negative number, but that's because people are entering the labor force and it's going to take some time for them to find jobs. And then you've got the wage growth that's clearly tapering off here, rising 0.2% month over month, versus a little bit faster. So you take that together with the JOLTS number, the job openings that slowed to 8.8 million. I think the Fed is going to say this is clearly a labor market that is rebalancing. It is slowing. The momentum is not as buoyant as it used to be. And that's great news because it takes pressure off the Fed.
So I know this is going to come as a big shocker to everybody here, but Nouriel Roubini does see a correction in the global equity market if economic conditions do soften.
If the global economy is going to weaken, if there is still a meaningful chance of at least a bumpy landing, probably markets have rallied too much today, and that's maybe going to lead to a correction in the second half of the year. 10% correction is not totally unlikely if the economy starts to soften up globally, and if you have still inflation that is above essentially target, with core being still high in US, UK, Europe, central banks hiking somehow more. I would not be surprised if in the second half of the year you get a 10% correction in global equity markets.
Anastasia, do you think we'll see a 10% correction, and would you be buying it?
Well, first of all, on average, if you look at markets, you do tend to have a 10% correction every single year. And on average, you have a 5% correction every single quarter. So, I think the probabilities, are probably there. But I don't necessarily expect, that deep of a correction this time around, because in the second half of the year, by the way, we're in September, so we have about 4 months of the year left to go. And we have an economy that I don't think is about to slip in a recession, because we're heading into September with very strong positive economic momentum, and the Fed that is likely to press the pause button on the rate hiking cycle. So I don't see that economic deterioration being the trigger for it. And the other reason, Alex, I would say maybe 10% is a little bit extended is because there's so much cash on the sidelines. And if you think about why we can't even seem to have a 5% correction without it being bought, is because a lot of investors likely missed the very robust first half of the year. And so they're looking for a chance to get back in. So as long as the economy is not falling apart, which I don't expect, and as long as people need to reposition, I think a lot of these pullbacks will get bought.
Mike, it's a similar question when it comes to the bond market. Do you buy the front end then?
Yeah, it's I'm not as bullish on the very front end as Rick Reeder is. I think, meaning like the 2 and 3 year part of the curve. There are a lot of rate cuts, almost 200 basis points of rate cuts priced in over the next couple, 3 years. And that is really aggressive. That's really assuming the Fed can pull the soft landing off, that they can pivot aggressively. On the credit side, akin to the Anastasia's comments on equities, the markets are pretty fully priced, right? The markets are pricing in a really high probability of this very benign soft landing scenario. And even though that's probably the base case, wow, there's really a good chance that either one, rates stay unusually high, which hurts risk asset valuations, or you do tip into weaker growth. And you look around the world, right, Alex, and China is like unraveling, and Europe is moving into a pretty deep manufacturing recession. So you have to really be careful on buying risk assets here. And we're defensively positioned, looking to buy the dips.
Where, Mike? Where buy the dips defensively?
In credit in general, investment grade corporate bonds look expensive to us. High yield corporate bonds look fair value to maybe a little expensive. We've been buying, certainly bank debt, the senior debt of the banks, whether it's the big money center banks or the super regionals, which obviously got killed a few months ago. Those are opportunities you want to buy on the dips, and even high quality, high yield. If spreads are 50 or 100 basis points wider, which is not that big of a deal, I think you're supposed to buy into that.
Which I guess begs the question, guys, is, when we price in those cuts, why are we pricing them in? Are we pricing them in for normalization? Are we pricing them in because the economy is getting hit pretty hard? Anastasia, does that affect where you want to be putting then cash to work?
Yeah, Alex, I think at some point earlier this year, the cuts were being priced in because it was consensus the economy is going to have a landing and maybe a recession, and the Fed is going to be forced to cut rates. And that's why we were pricing in quite a few rate cuts. But I think now that has shifted quite a bit, and we're on track for a soft landing and the economy that still chugs along. But the reason why the Fed would cut rates even under that scenario is because as inflation trends down towards 2%, if the Fed does nothing, that the real interest rates is actually going to start to rise. And at the current juncture, Alex, I don't think the real interest rate is even restrictive yet, or maybe it's just on the cusp of being that. But if inflation falls, real rates go up, we are going to find ourselves at some point in a place above neutral, and that's what would potentially cause the Fed to cut rates. So I don't think the economy needs to fall apart for the Fed to do that. It's just the inflation needs to continue to slow.
Which brings us to can we have a job-full slowdown? I was going to say recession, but let's put that out. Like a job-full slowdown. Mike, what do you think?
The job market is starting to weaken in a lot of ways. Even today's number, that all those people that come, it looks like they came into the labor force, a lot of them were actually employed people who've moved onto the unemployment payrolls, and the wage gains are moderating. So I think you're going to see the unemployment rate tick into the 4s, and let's all hope it stays in the 4s, right? History, if it's any guide, is not a good indicator for a soft landing. Typically, when the unemployment rate starts going up, the end is nigh. So you really have to be careful there. But the economy in general is on decent footing.
And Anastasia, okay, so if Mike's kind of watching that 4% U3 level, what's the data point that you're watching to sort of tip the scales into a job-full slowdown?
Yeah, I mean, it's definitely continuing to watch layoffs. And I guess if we do have, several more months of, some layoffs that are starting to show up and the unemployment rate continue to trend up, maybe that does raise a question of whether that's kind of the first shoe to drop. I don't expect that to happen at the moment. And Alex, I wanted to come back to kind of another point that we're all circling around, which is, yields at 4 or 5%. I think everybody's scared of this level and is saying the risk assets can do well in that environment. But if you go back prior to GFC, the 10-year around 5% is the normal. So is it possible that we're just going back to that old normal where you've got inflation that's certainly higher than it was post GFC, where you've got growth expectations that have actually picked up, and you've got the Fed that's going to keep rates around 5% for a prolonged period of time? I think that's exactly what we're going back to. And by the way, that's not a disaster for risk assets. If you look at the performance, prior to GFC, you've had corporate bonds that outperformed the treasury market. You've had private equity that did well, and so did equities.
All right, we got to leave it there, guys. Anastasia Amoroso, Mike Collins, you were sticking with me, so hold that thought. Coming up, morning calls. Plus later, Deputy Secretary of Labor Julie Su joins us to discuss the August payroll report. That conversation right after the opening bell. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Time now for morning calls. Analyst recommendations on Wall Street this morning. Got Loop Capital downgrading Dollar General to hold, saying retailers disappointed results. Up next, you got Evercore adding Illumina to its tactical outperform. And finally, you got Morgan Stanley naming Dell as a top pick, pointing to robust demand for AI servers. The opening bell up next. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is a countdown to the open. I'm Alex Steele in for Jonathan Farrow. We're moments away from the start of trading. Louisville, Kentucky, apparently. That's where we're going to bring the nicey bell this morning. You got S&P futures up about 0.5%. The good news in the job market, good news in the equity market. That's holding firm. Switch up the board, and let's just see where else we're trading here. So in the front end, you're seeing some strong buying in the bond market with yields kind of moving lower. And the back end, kind of debating if we want to be bullish or bearish there. Dollar overall also weaker. And crude, I want to point out, the highest level that we've seen since November. Is that an economic demand story, or is that just potentially a weaker dollar story? But for now, good news is good news as the market opens on this Jobs Friday. All right, couple stocks to watch right here at the open. You got Broadcom and Dell, the two tech companies heading in very different directions after earnings. Chipmaker Broadcom delivering a downbeat forecast, while shares of Dell are surging amid signs of rebounding demand on PCs. Bloomberg's Ed Ludlow joins us now from San Francisco with more. Ed?
Yeah, good morning, Alex. Happy Friday. Two very different directions. Let's start with Dell, the stock trading at a record high now, on track for its biggest jump since March of 2020. The story is decelerating growth. Actually, revenue fell 13% year on year to $22.9 billion, but that was still ahead of Wall Street's expectations of around $20.8 billion. EPS, $1.74 a share in the quarter gone. The Street was looking for $1.14. It's the outlook that we go to. CFO Yvonne McGill saying that revenue will be $23 billion in the current quarter, which ends in October, way ahead of expectations. And there are signs that corporate demand, at least for both their PC and data center products, bottoming out. But we go to the AI story, and they call AI a long-term tailwind. And that is something that, if you look at the sell-side notes, they are buying into this Friday morning. Broadcom, a very different story, down 3% on Broadcom shares. They're seeing pretty slow growth, the slowest top-line growth in years. But the narrative from executives is that the data center-specific chips relating to AI are gaining traction, and they're seeing demand. Broadcom does two things. It makes the chips that allow for the transfer of data between specific computers within a data center. So when AI-related function or AI clusters are being built up in a data center, they should benefit. They also make custom silicon for some of the names in the hyperscale market that are building AI-specific data center. But realistically, you go straight to the outlook for $9.27 billion in the fiscal fourth quarter. The range of estimates from Wall Street were ahead of that on the bottom end and much higher on the top end. And the question is, why is Broadcom not able to take that demand it's talking about in AI and turn it into tangible revenue growth when NVIDIA is able to? They're the same story. It's just that Broadcom's not growing, and that suggests to us that its other parts, so its other businesses, i.e. the Bluetooth Wi-Fi modem it does for Apple, and other data center spending is uneven right now.
Yeah, and it just highlights when you get that NVIDIA quarter, like just how much maybe others are struggling to monetize that. Ed, thanks a lot. Ed Ludlow joining us to stay with earnings for a moment. Shares of Lululemon moving higher after the retailer raised its annual forecast. The CEO striking an optimistic tone, saying, quote, our continued ability to gain market share illustrates the significant runway ahead. Bloomberg's Simone Foxman has more. Simone?
Yeah, Alex, Lululemon meeting or outpacing even by a slight bit all the metrics that Wall Street was really looking for. Comp sales up 11% year on year in North America, testament to the strength of that high-end U.S. consumer. Internationally, sales picking up as well. Sales in international markets rose 52%. Part of that was the China reopening. Part of that was store openings in China. International sales now constitute 1/5 of Lululemon's overall sales. That allowed the company to raise its expectations for revenue and profits for the year. For the full year, now sees net revenue $951 to $957 billion, or $9.51 to $9.57 billion, I should say. That's above the estimate from Wall Street that was about $9.5 billion. Maybe the reason we're not seeing a bigger move here, though, up just about 2%, is because Wall Street was already extremely bullish on the stock.
No, fair enough. Simone, thank you very much. Let's turn now to a showdown in the media space, a contract dispute between Disney and Charter Communications, leaving millions without ESPN just as the college and NFL football season kicks off. A Disney spokesperson saying, quote, we are committed to reaching a mutually agreed upon resolution, and we urge Charter to work with us to minimize the disruption to their customers. Bloomberg's Isabel Lee has more. Isabel?
Hey, Alex. Minimize disruption indeed, and a lot of TV lovers aren't happy. So this all began because of a feed dispute. So Charter says Disney declined its proposal and pulled its video channels from Charter on August 31. So Charter says it's currently paying about $2.2 billion in annual programming costs to Disney, but only around 25% of its video subscribers regularly engage with Disney content. So Charter is the second largest TV provider in the U.S. It has around 15 million subscribers. And this is a big deal because, as you pointed out, sports season is underway, and this affects the likes of ABC Videos and ESPN. Media companies, though, have long fought over pay TV provider for years, and this often leads to contracts and some blackout periods. For now, both shares are down. You see Disney down around 3% and Charter also down around 2%. Both parties are said to be negotiating, Alex.
All right, Isabel, thank you very much. And finally, let's go to the automakers. Tesla back at it again, implementing yet another round of price cuts for their premium vehicles in both China and the U.S., making the Model X eligible for a government EV tax credit of $7,500. Katie Greifeld has more. Katie?
Hey, Alex. Yeah, there's not too much movement in Tesla shares this morning. They're down slightly, but some pretty interesting news across the lineup. We're going to get to the price cuts, but they also revamped their Model 3 sedan for the first time since they started production 6 years ago. That Model 3 now rated to go 377 miles on a single charge in China. There's also two new colors, Stealth Gray and Ultra Red. Very fun. But probably more consequential to Tesla's bottom line are those steep price cuts to the Model S and to the Model X in both the U.S. and China. Tesla now charging just below $75,000 for the base Model S and just below $80,000 for the Model X. That is according to the U.S. website. Now, for context, those vehicles came into 2023 with starting prices of almost $105,000, $121,000 respectively. Of course, we've gotten used to this from Tesla. They've been cutting prices in both markets all year, really, in an effort to boost sales that's been coming at the expense of profit margins. And it's a big question for Tesla how they continue to ramp up sales here. You wouldn't know it by looking at the shares. In 2023, Alex, up over 100%.
Katie, do we know what color Stealth Gray is?
I don't know what Stealth Gray is. It sounds like black if you really wanted to be stealthy, but the Ultra Red is pretty cool.
No, totally cool, but you can't drive that in New York City. The Stealth Gray, I don't know, maybe. All right, Katie, thank you very much. We're just a few minutes into the trading day, the first trading day of September, because like, when did that happen? You're looking at upside on the markets here. You got the S&P up by 0.5%. Volume finally recovering after a dismal week of volume in the markets. We're going to see how long that actually goes. Consumer discretionary, energy, information technology, materials, all on the upside within the market. Okay, so let's get a little bit more in there. Let's get into the consumer discretionary. That's obviously going to be helped by Lululemon, doing pretty well. Etsy as well. All right, the 2-year yield is down by about 6 basis points, 4.80. So you're seeing the money come into the front end The back end, though, isn't really sure what to make of this. You're seeing yields move a little bit higher here on the 10-year, 4.12%. Rick Bader, not touching the back end. BlackRock overall was saying you got to see 4.5% on the 10-year before you want to think about buying. He does like the front. He does like the belly. And the idea is that the Fed can stop raising rates. There is enough pain in certain areas of the economy in order for them to stop, and the labor market seems to be holding up. Let's get back to those labor numbers. It is a solid market here. 187,000 jobs added, a 3.8% unemployment rate. I want to welcome our Bloomberg TV and radio audiences. I'm Alex Steele, and joining us now from Washington, D.C. is Julie Su, Acting U.S. Secretary of Labor. Secretary, pleasure to speak with you. Thank you for joining.
You too.
The market sees this as a good report. Good news is good news for the market. How long can this good news continue from where you sit?
Right, that's right. That's the right characterization of this, right? This is exactly what you'd want to see if you're looking for a soft landing. This is if you average the last 3 months, it's about 150,000 jobs each month being created. This is the transition from the breakneck speed of the fast recovery we saw initially when President Biden first came into office to the consistent, steady, stable growth that you'd want to see in a strong economy.
The one really big axe here, Secretary, is what's happening with the unions. You have the Hollywood strike still ongoing, the actors strike still ongoing. You have a potential auto worker strike that could hit the big three. You have trains, you have dock workers. There's a lot of union action right now. Is the White House in active conversations with these unions?
Right, so this is, we're continuing to see the effects of a tight labor market, right? We continue to have now unemployment at less than 4%. This is the longest stretch since the 1960s. And in a tight labor market, workers have more power. We've seen workers come back to the labor market and make choices about what it means to have a good job, a good family-sustaining job, a good job where they can, make demands to improve their lives and their working conditions. And the unions are a part of that. Now, you mentioned some unions where, through those demands, they've resolved issues that were longstanding, that have raised wages and addressed certain conditions. You mentioned the ports. That's one area. We saw that with the Teamsters and UPS last month. We continue to see workers making these demands, and these are not just like a sort of an accident in an administration that supports working people. This is really part and parcel of workers being able to demand their fair share.
Sure, but when you take a look at the auto workers, for example, how does the administration avoid Sean Fain as the head of the United Auto Workers overplaying his hand? The increases in demands that union is asking are tremendous. 45% wage increase, 32-hour work week, things that many say are very unrealistic. And if those workers strike, we could be looking at a recession. That's what some are saying. How does President Biden handle that?
Yeah, I mean, we have definitely seen wage increases in contracts that have been signed. We've seen them wage increases, over 6-year periods, right? Multiple year periods. I think for a president who believes, as I do, in the collective bargaining process, we trust the process, right? We allow the parties to stay at the table. They are staying at the table. That's a good sign.
Yeah,
parties
but
are always far apart until they're not.
The Secretary, if they stay at the table and then eventually they strike, they don't get what they want, you're looking at 150,000 plus people out of work. That is going to have a tremendous drag.
Yeah, I mean, that's right. And so that's why we remain hopeful that the parties will resolve their issues. We trust their process to do that. Obviously, strike is a part of that too. And everybody would love to see a path forward where the union and the employers do the right thing. These are, a moment in which union members are seeing historic profits coming out from, a pandemic. I think the parties have to remain talking.
So to that point, do you think that the big three are negotiating in good faith? Sean Fain doesn't think so. Do you think so?
I'm not at the bargaining table. I'm not there. I do think that some of the, what gets said is reflective of what's happening at the bargaining table. Some of it is not, right? There's lots of things that happen during the process of a negotiation. I think it's important for us to allow the parties to do what they need to do, and that's That's what we're doing here.
I totally get it, and there is a process. But if President Biden is facing something like 3 big auto strike working, so 150,000 people maybe out of jobs plus, or a 45% increase in wages, both of those are difficult. On the one hand, you have a recession fear. On the other hand, that's going to lead to higher inflation with wages. Which side are you going to come down on?
Well, I think overall, right, as we talked about with the jobs numbers, we are seeing really solid job growth and a solid, strong economic picture. I think it's important not to make too much of any one part of that. And each time there's been a contract that is about to expire, there's been a whole lot of hand-wringing over what's going to happen. I think it's premature. I think the contract is not yet expired. It's important to allow the parties to do what they want to do. But I will say, this president, one of the pillars of Bidenomics is to believe that an empowered workforce is a good thing for working people. And that is something that he's been unwavering about.
So that really does feel like support the wage gains, even if it might come at the expense short-term of the economy. Is that a fair characterization?
Well, it's really about supporting the parties negotiating in good faith to grapple with hard issues and arrive at a place where, the president often says, when workers do well, employers profit, and the economy is stronger. That's what we'd like to see.
But before I let you go, and I'm saying this in jest, but I actually mean it, Taylor Swift has truly driven the economy in many ways. Just look at AMC. And I'm wondering, do you talk to Taylor Swift? Like when she stops going on tour, are you actually going to be looking at like a weakening labor market and a weakening economy? I'm joking, but I'm also kind of serious.
Right. So I'll respond with, women are powering this economic recovery. Women are at the highest levels of, percent of women in jobs for the 5th month straight, record-breaking. And remember, during the pandemic, women were really devastated by, the lack of paid leave and the lack of care. We've seen women come back in really high numbers and get jobs, and we need to continue with that trend of making sure that women get to participate fully in the economy and the good jobs that are being created.
Yeah, I don't think Taylor Swift had a problem with that. I don't think her roadies, though, are women, but okay. Thank you very much, Secretary. Appreciate it. Julie Hsu, Acting U.S. Secretary of Labor. All right, coming up, President Biden preparing to deliver remarks following the latest payrolls report. So that conversation coming up next with iCapital's Anastasia Amoroso and PGIM's Michael Collins. This is Bloomberg.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's Renewable Assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional assets monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, oh, the hour it's off. No, it's by the minute, and then it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
For further market analysis, we're going to go get straight to some breaking news.
We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
This is if you average the last 3 months, it's about 150,000 jobs each month being created. This is the transition from the breakneck speed of the fast recovery we saw initially when President Biden first came into office to the consistent, steady, stable growth that you'd want to see in a strong economy.
That was Acting Labor Secretary Julie Hsu making the case for Biden economics following today's jobs report. The president also facing surging gasoline prices ahead of the upcoming election. That's not a good combo. Let's go to Anne-Marie Hordern in Washington for more. Anne-Marie?
Yeah, Alex, when it comes to the jobs and inflation question, this is something the president has been struggling with because when you look at the polls, while his overall approval rating is north of 40%, it's much lower when you look at where this president is rating when it comes to economic issues. And now while we have seen a strong labor market, there's things today that the president is probably going to nitpick out and want to really try to assuage American concerns, like the unemployment rate that has ticked up. The president is likely going to say that this is the 19th month in a row that you still had the employment rate under 4%. And also, while the unemployment rate did tick higher, it did drop for Black Americans, something the Biden administration is certainly going to want to tout as they campaign for the presidential election in 2024. The biggest issue, though, facing this president, Alex, as you know, is not the job market, and that is inflation. And as long as inflation continues, at least the rate of inflation continues to come down, that will help them along the timeline of the election of next year. But really this, when you look at what gas prices are now, but still Americans are still complaining about higher food prices, higher rent, that's really the crux of the issue.
Yep, and then maybe some worker strike in the auto industry. Anne-Marie, thanks a lot, appreciate it.
Yep,
so with me, Anastasia Amoroso and Mike Collins joining me here. Hey, Anastasia, and thought on both of you guys for this. Anastasia, are we at a risk here for like a serious auto strike, and sort of how are you thinking about that? Question for both of you guys, but Anastasia, go first.
Yeah, Alex, I think you brought up some really good questions during the interview. And, you know, the thing that really stuck out to me is, you know, let's say we do end up averting the strike, but there is this real wage pressure that is happening in the economy still, because with the labor market being as tight as it is, not enough workers available for some of the key industries, you definitely have the ability to, you know, for this collective bargaining power to generate wage gains. And you know, that poses a two-way problem. And of course, it has its benefits as well. But the problem is that this 4.3% year-over-year wage growth may actually stay around these levels if you continue to have this sticky wage pressure. So I think that's a real concern in the market. But the other thing, Alex, is I think is going to push more and more companies to look at what they can do in terms of investing in technology and investing in artificial intelligence to potentially circumvent some of the wage pressures that are building otherwise.
Yeah, although then unions won't like that either. Mike, what do you think?
Yeah, I mean, these headlines of these huge wage gains the unions are garnering are really eye-popping, Alex. But, you know, we've actually parsed the data. You know, unions are only 5% of the private workforce now. And even if you take these big, you know, headline wage gains, it's barely a rounding error in terms of impacting the overall wage gains. And you know what? Forget about Taylor Swift. I mean, this old Jersey boy is heading to the swamp of the Meadowlands today to tailgate and see the original boss, Bruce Springsteen.
Okay, well, fair enough, but come on. Taylor Swift had like a record-breaking tour. I mean, sorry, boss, but it ain't the same, Mike. He's gone. He doesn't want to talk to me anymore. Okay, well, that's fair enough. Guys, we're going to leave it there. We appreciate it. Anastasia Amoroso, Mike Collins, who doesn't want to talk to me anymore, over Bruce Springsteen. All right, coming up at the market moving events you need to be watching. That is coming up next in our trading diary. This is Bloomberg.
large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Into the open here on this Friday. I gotta say, we're losing a little bit of steam. The S&P now up just 0.3%. The NASDAQ now flirting with negative territory as front-end yields move much lower. You still have a nice solid rally here with the Russell, but I want to point out the bond market because yields in the long end are ticking higher. The front end is still lower, but that's just by 3 basis points. So we are losing a little bit of this steam. The 30-year, I should point out right here, down by about 6 basis points. The best performing sector so far in the S&P is energy, and that's because oil continues to hit that level that we haven't seen since November of last year, but the dollar also just flipped into positive territory, so you have to wonder how long that move is really going to last. All right, let's wrap it up now with the trading diary. This is everything you need to be watching this week. So U.S. markets are closed Monday for Labor Day. Have a wonderful day off, everybody. We're also going to get factory goods and durable goods orders on Tuesday, so keep your eye out for that. Then Wednesday, lots of Fed speak from Collins and Logan, plus the Fed releases its beige book. And Thursday, we're going to hear from Harker, Williams, and Bostic, plus another round of jobless claims. Will they support this solid job market? Let's get right back to those numbers here. Non-farm payrolls coming in better than estimated, 187,000. If you were backing out the yellow truck bankruptcy and the workers, it would be even hotter. You also have the unemployment rate moving higher to 3.8%, but because the labor force participation rate also moved higher, and that is a good thing. You have hourly earnings on a year-on-year basis coming in 4.3%. Goldilocks. Markets taking it as Goldilocks. This is the countdown to the open. This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City,
From London and Sydney.
from Washington,
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Jessman and John Tucker here in the Bloomberg Interactive Brokers Studio. I hear Matt Miller and Paul Sweeney both have the day off, conveniently heading into the Labor Day weekend, JT. But stick with us the next 3 hours. Coming up, President Biden is expected to speak on the jobs report around 11:15 Eastern this morning. We'll also have Bloomberg's Michael McKee shortly to weigh in this morning's jobs report, and Ben Amons from New Edge Wealth to weigh in also on the bond market. But first, let's get a quick check on the latest ISM data that just hit with John Tucker of Bloomberg News.
I wasn't even prepared for that, but I'll do it. This is
Sorry to put you on the spot.
This is
JT.
for August. The Institute for Supply Management.
I can jump in on it if you want.
The factory index, no, I got it, rises to 47.6. The previous reading was 46.4. The estimate was for 47, so higher than expected. I'm going to call this tertiary, maybe the secondary or tertiary data at this point. As far as equities right now, after the jobs report that we got 8:30 Wall Street time, S&P 500 16 points higher. That's up 0.4% at 45.24 on the index. The Dow Jones Industrial Average up 170 points. That's a rise of 0.5%. And the tech-heavy NASDAQ 100 right now 12 points higher at 15,515. In the broader index, we have 8 of the 11 major industry groups. They are higher right now, being led by energy as you enter into the Labor Day holiday weekend. Fuel prices are higher. And the 2-year yield, that is now down just 1 basis point, 484. You'll recall after the jobs report that we got earlier this morning, that was down as much as 10 basis points, so recovering a bit there. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Jess?
How excited are you for the next couple of hours, JT?
Oh, I haven't been this excited since I don't know when.
One of the producers told me a trigger for you is apparently congestion pricing.
Yeah, don't go there. It's just like
too soon?
well, that's in
Too
New
early?
York City. It's just like it's just another thing that's tacked on to my commute and everybody else's commute.
I mean,
and when you're paying more for your tolls and commuting expenses than you are for your mortgage, maybe it's time for a rethink.
There we go. Well, I'll tell you, I'm really excited for the next couple hours because you are a legend when it comes to Bloomberg Radio. So it's going to be lots of fun. I want to bring in...
Oh, somebody sold you a bill of goods.
Simone Foxman, who covers markets for us here at Bloomberg. And we have clearly a lot of things going on this morning on the back of the jobs report. But when it comes to individual stock movers, what are you keeping a close eye on this morning?
Yeah, I mean, set aside the jobs market for a second and look at shares of Dell. They're rallying more than 20% after particularly strong earnings. The COO, Jeff Clark, said he was encouraged by the macro environment in the second half with a particular pickup in June and July. But this is both because PC sales were better than expected and also analysts really keen on the AI server business at Dell. That doing particularly well. They have a partnership, by the way, with chipmaker NVIDIA. So that's probably one of the biggest movers right now, up 21%.
On pace for a record close if it holds on to these close. So, ticker symbol DELL. So it's pretty amazing there. Another one we had been chatting about yesterday, Simone, was Lululemon. And they did report after the bell yesterday. What did we hear from them?
Okay, so everyone expected that the high-end consumer was going to be pretty strong. And guess what? It was. The company pretty much either meeting or slightly exceeding all the metrics for 2Q, but particularly seeing a strong outlook for 3Q. So comp sales up 11% year on year in North America. Again, that high-end consumer continuing to spend. The company raising its outlook on revenue and profit above analyst estimates, but really sales internationally picking up a lot, up 52% year on year. A lot of that's the China reopening, some of its store openings in Thailand as well. International now a fifth of sales. The Wall Street's already pretty bullish though. I mean, we're seeing shares up 2.75% right now. You know, price targets are well in the 400 range, the average analyst price target, and we're trading, it looks like, it's
around
391. Yeah,
right.
there
Can
you
I
go.
call this some sort of bellwether for consumer spending or not?
I mean, it's that leisure wear. People are still willing to spend at least $100 on some of
But
these
where are they
yoga
getting all
pants.
this money from?
Thank you. That's what I want to know.
Well, I mean, maybe it's because the job market's strong, right? People are still employed. The high-end consumer's still employed. There you go.
Wage gains.
I think they're using plastic, but that's just me.
I don't know. Whatever they do.
Hey, you know, we're gonna get another.
It makes your lower half look really nice. I have to say, I wear Lululemon. I'm not wearing them now, so don't look.
We will get a reading on consumer credit at the end of next week, so we can take a little closer dive there when you're talking about that plastic. JT, what other stocks are you keeping a close eye on this morning?
Okay, this one is fun. 23andMe. So this is a genetic testing company. You may have heard of it. And they received a couple years ago, 2018, the initial authorization to report on some variants, 3 variants of the BRCA1 and BRCA2 genes that increase risks for breast, ovarian, and prostate cancer, as well as pancreatic cancer, actually. Now they got FDA clearance to report on an additional 41 genetic variants, many of which affect African American, Hispanic, Latino communities. I think this is so interesting, right? Because it's very hard to test. Well, it's not very hard. It's challenging to go test for these things, but you have this consumer company now able to do it. You send in a swab, they can do it. So shares there popping up about 3%. They've been up more in the pre-market, but I don't know. I think it's like one that's close to people's heart, people's health.
What do they do? They genetically screen you for the possibility of you being predisposed to certain diseases so that you can prepare.
That's right. So some of these genes, breast cancer in particular, people will talk about one of these variants, giving you a very high likelihood of having breast cancer. So people will go well out of their way to kind of prepare for it. There is some, again, I'm not a medical expert here, but there is some varying science about how likely you are and what the best course of action is. But I mean, the idea that you're bringing some medical testing a little bit closer to the consumer, whether for good, because it allows people to know if they're indisposed to these things, or for bad because, where do you go in policy perspective? That unclear, but I think it is interesting.
Right. My last stock I wanted to point out, Walgreens, ticker symbol WBA, that stock down about 3% this morning. What's happening?
Yeah, Roz Brewer, the CEO, departing after less than 3 years. The company's really been trying to break into more lucrative parts of the healthcare space, and it's been a struggle. I mean, you think about what's happened in the past 3 years. She really oversaw a lot of the response to COVID-19, but now it appears that that tenure is over, and the market reaction down about 3%, not really that positive. I will point out Walgreens shares down about close to 35% year to date, though. So maybe this is a good reflection of that.
All right, Simone Foxman, Bloomberg News reporter. She's actually going to be back later in the program with us, so I'm excited.
When I'm kick out JT.
Yeah. Whatever. Well, JT comes in super early.
I go voluntarily,
so
by the way.
He'll turn into a pumpkin, and Simone will be back with us. So I'm looking forward to that. Thanks so much for coming up with the latest with the stock market. I want to switch gears and bring in our next two guests. Michael McKee, who's here in studio. He's the international economics and policy correspondent, as we know, with Bloomberg News. And Alice Andre, who's our U.S. interest rates and FX reporter with Bloomberg News, joining us on Zoom. Mike, I have to start with you and get your take from this morning's jobs print.
Well, it's a pretty good outcome, put it that way. It depends on where you sit, whether you think it's a good report or not. For the Fed, it's a good report in the sense that it validates their view that unemployment would have to rise to bring down inflation, and that their rate increases would put pressure on the labor market. And it does show the labor market is loosening up. Unemployment goes up to 3.8%. 736,000 people joined the labor force. Now, some of that is probably a seasonal adjustment issue, but it does show people coming back into the labor force, which is what the Fed has also been looking for. Now, if you're a worker who's worried about keeping up with inflation with your wages didn't rise as much, 0.2%. Good news on the inflation side, bad news on the keeping up with inflation side. And then those who didn't get jobs or who lost their jobs and the unemployment went up is basically not good news either. So a kind of a mixed report with the numbers, but in terms of the overall macro economy and the Fed outlook, good news.
Alice, I want to bring you into this conversation. Break down what we're seeing in the bond market reaction to this report.
That overall, the bond market is viewing this as a weaker report, which was as expected, but not outright weakness. I think that traders are viewing it as a moderation accelerating, but that's exactly what the Fed wants. They want the labor market to come back into better balance. And I think that what the bond market is saying is that this probably puts the majority of the Fed participants on hold. And I think that it also really doesn't take the final hike off of the table, and I think that bond yields are reflecting that today.
Yeah, initially, it was at least a 10 basis point drop in the more policy reactive 2-year. We're back to down 2 basis points right now, 483. One of the questions I want to ask, did I miss the boat on rates, putting all my money in nice, safe treasuries at a really healthy yield?
No. I think you have some time on that. Like I said, I think that people think that the Fed's going to be on hold for a little bit. And, rates are probably just going to trade a bit of a range, and they're definitely going to be very data dependent. That's when we're going to see big moves, is on big data days, probably the next one being CPI. And, you'll have your chance, but I think that I think it's pretty clear that the economy is not falling into recession, and I think that rates are going to stay high for a long time. I think that there's been a move in the back end, further out in June and May Fed funds, and now they're reflecting that the first cut will come in May instead of June. But, it was kind of a small move. I think that the thing that you really got to keep your eye on is the November Fed funds, and they're still pricing a very good chance of another hike coming.
Yeah, we have, since it's Friday, we have a drinking game in the studio.
Every
time somebody uses the phrase Goldilocks, we have another shot. Is this Goldilocks, Michael McKee?
Goldilocks, John. Goldilocks.
Thank you.
Yes. I want to see you crawl out of here. You could that description is being used on this because it basically is, as she said, slowing, which is what the Fed wants without crashing. I mean, the economy is still growing, and we're still adding jobs at a pace above the level needed to absorb new entrants to the labor force. So, things are pretty much in a fairy tale world.
One thing I'm curious about, Mike, is July had 2 more weekend days than June. How does that affect the wage print?
It doesn't affect the wage print. It can affect hours worked, but the wages are going to be based on what you're being paid in the week that includes the 12th of the month, the pay period that includes the 12th of the month, which is very complicated because if you get paid once a month, it's the entire month. If you get paid every 2 weeks, it may be just you get into part of it, and sometimes people aren't included at all if you're a freelancer and you get unusual pay periods, which is one reason we did not see the SAG-AFTRA strike show up until this month, because some of those people aren't paid on a regular basis.
Alice, I know coming into this, you wrote a piece on the team talking about how bonds were at risk for a rally based on what potentially could happen with this August data. How do you view the direction of the bond market, and particularly yields in the 10-year moving forward in the next couple of weeks, to your point, because we do have that September CPI print on the 13th?
Yeah, so I mean, it was a really pretty easy setup for the bond market today. I mean, all the metrics showed, most of them. I think there was 2 indicators. It was one of the S&P Globals and claims was really the only positive thing for this payroll report. All the other ones were negative. All the Fed reports, all the ISMs, they were all pointing to a weaker report. And so the setup for the bond market was pretty easy. I mean, everybody knew that it was going to rally and then we were going to sell off right away. That we were going to sell off right after that. And I think that part of it is a function of what we're waiting for on Monday. We're looking for a lot of corporate supply to come into the bond market. And so bond traders are just preparing for that. They're either selling because they're going to take down some of this corporate supply on Tuesday, or you're seeing issuers coming in and rate locking. So that's part of this pullback today in prices and yields going higher. As it moves forward, I think, like I said, we're just going to trade the range. I think that they're going to, bond traders are going to part and parcel every single piece of data. And one of the pieces of data that I thought was pretty interesting was yesterday's Chicago Purchasing Managers report. And they really don't give you a whole lot of information in the report. But what you can glean from it was that new orders and production moved from contraction to expansion. And also employment, I had heard, had a very big uptick, and in fact it did slow. It contracted, but at a slower rate. And so to me, that just really kind of gives the same picture of one that the economy is showing some glimmers of starting to pick up, which is what we've been anticipating, that we're going to see a big pickup starting in the second half, and that's why people are hoarding their labor and they're just using layoffs as a complete last resort. The other thing that I wanted to say is that on Monday, the Dallas Fed manufacturing report talked about the fact that most participants think that they're going to raise wages at a rate of 5% this year. And so that's far and above inflation and above what we're seeing in average hourly earnings. And so you could get an uptick in inflation based on wages again. And most of the Fed surveys had talked about this year, even recent ones, that they're just going to have to continue to raise wages, first of all, to keep up with the demand that's expected, but also because they can't afford to let go of their labor force, so they're just going to have to raise wages.
Right.
The other thing is on that work week, I thought that was pretty consistent with what we've seen from some of the Fed surveys, that the uptick in the work week was consistent with, you put your workers to work doing other things on the factory floor or in your shop. to keep them busy.
Right.
Mike McKee, final thought in 20 seconds.
Next week, number of Fed speakers.
Yeah, we have a number of Fed speakers. We have John Williams, the New York Fed president, coming in here to Bloomberg, and we'll get their views. But I think this kind of, unless we get on the 13th of September a really surprising CPI report, this probably locks in a pause. The Fed does not have to raise. It doesn't make the case for raising at this point.
Right, so John Williams next week, former Fed official Jim Bullard also on the calendar, as well as Susan Collins. So Michael McKee, international economics and policy correspondent with Bloomberg News, and Alice Andre, U.S. interest rate and FX reporter with Bloomberg News. We'll have more coming up. This is Bloomberg. Now let's get some company news with Bloomberg's Lisa Mateo.
Thank you, Jess. The clock is ticking before a contract for the United Auto Workers expires next month. AGF Investments chief U.S. policy strategist Greg Valliere spoke with Bloomberg Surveillance earlier about whether or not a strike could be averted.
We averted a strike with the Teamsters and UPS, so it's possible it could be averted. But in the last 24 hours, there's been a lot of nasty talk. The union is saying the companies are not bargaining in good faith. So this will go right down to the wire. Even if there's a deal, the other big story here is how enormous the salary increases are going to be.
You can catch the full conversation on today's edition of the Surveillance Podcast. Meanwhile, the United Auto Workers president, Shawn Fain, says he's not optimistic about the contract talks. More from Bloomberg's Erica Hershkowitz.
The UAW has filed an unfair labor practice complaint against General Motors and Stellantis for not responding to their contract offer. Fain says Ford's reply of a 9% raise was an insult. The union wants a 46% pay hike and an end to the two-tier wage system, saying the contract expiration date of September 14th is a hard deadline for a potential strike.
All right, so let's check in with shares of General Motors right now. Down about 0.2%. Stellantis down nearly 2%. Ford shares right now down up about 0.5%. And UPS is offering voluntary buyouts to 167 of its pilots. They say air freight demand is in a slump as people spend more on experiences and less on goods that need to be shipped. The company has 3,400 pilots. Now, that offer will include cash and health care benefits. Shares of UPS right now down up about 5%. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Equities are higher. It's a risk-on day. S&P 500 right now up 25 points. That's a rise of 0.6%. As we close out the week and start a new trading month, we're at 45.32 on the index. Dow Jones Industrial Average is up 222 points. That's a rise of 0.6%. 34,943. And the NASDAQ 100 right now 51 points higher. That's up 0.3%, 15,553. The two-year yield, kind of a fade right there. Two-year yield right now down just 1 basis point. We're at 484. Remember earlier in the session, we're down about 10, 11 basis points after the release of the non-farm payrolls report. Non-farm payrolls rising 187,000 after the prior 2 months were revised significantly lower. The statistics from the Labor Department this morning. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Jess.
You and me.
I'm not going to toss back to myself.
I know,
that
so
wouldn't really
you could say
make
Jess
any
and
sense.
JT if you wanted to refer to yourself in third person.
The third person.
Continuing the fun, so I'm glad you gave us an update, obviously, on what's going on with those bond yields, especially when you're looking at the 10-year as well as the 2-year. But who better to break us down when we're looking at what's happening in the fixed income market than Ben Emmons, head of fixed income at New Edge Wealth, who I've known for a long time, joining us to talk to us also about how markets are responding to this latest jobs report. Ben, it's always a pleasure speaking with you. Let's start off with your take on this morning's jobs report and your sort of view on how this could impact the fixed income market ahead of the Fed decision on September 20th.
Hi Jess, hi John. Happy Labor Jobs Day, right?
Thanks for joining us on a quieter day here, heading into the Labor Day weekend.
Yeah, and I'm all casual here. I'm seeing myself streaming live on YouTube.
Right.
And, casual shirt in California, but let's do it. So I kind of echo Mike McKee's points. Like, this is a jobs report where if you're seeing that many people getting pulled into the labor force, which is like 730,000 or so. It tells you that the labor market is quote unquote in demand from people wanting to really get back to work, to try to make more money, and that's good for the economy, right? That's productivity. That's actually a very positive sign. So it is an interesting reaction in the bond market how the number came out. It was sort of in line, the headline, and then people go through the details to see like, yeah, there's loosening of the labor market here. That's what the Fed wants. So the yields on the short end 2-year go down. But then as we go on a little bit, in the session, you see long-term interest rates start to rise a little bit. And there's that ISM data just came out, which was a bit stronger than expected, but the employment component in there too, better than expected, as well as prices paid. You see this shift in the yield curve with long rates going up. And I think you take the payroll support and ISM together, it tells you like, there's not a weakening economy. This is just more people coming into labor force, so looser labor market. What the Fed's looking for. On the other hand, the soft landing, no recession scenario stays in place. And this is why you're getting this steepening of the yield curve on both the shorter end of the yield curve and the longer end. So that's, I think, a very Goldilocks moment.
Goldilocks.
Yeah.
Goldilocks.
Ben, you know about our drinking game here. What is he, the fifth or sixth guest to say Goldilocks
Let's keep a
at
tally.
this point? As far as the inflationary components, how much bargaining power do workers have over employers?
Yeah, they still do, John, because I think that the wage trackers from the Atlanta Fed still show a big difference between those who can quit their job and those who stay in the job, for example, and meaning people quit their job to try to find, better paying jobs. That's still a difference there. You also could think of that the job openings ratio to employment that's still elevated to pre-pandemic. It also indicates, right, that the companies are still actively looking for positions to be filled, but all of those metrics have moderated from the real elevated levels. So these strikes that we're talking about and these wage settlements that we're going through currently, it does show that labor is really having control here. Now, the UAW strike actually happens, it would be a negative for the economy. So it does look that they want to try to get bargaining to a better deal. I would point out, though, that if this leads to a real good deal for the workers, there's a little bit of that 70s idea of pattern bargaining, right? One union wins a good agreement, other unions will try to do the same thing. So I think we'll stay a little bit in that dynamic.
One thing I've been thinking a lot about, Ben, is just the 10-year in relation to where the S&P 500 is trading. So say earlier in August, we did see the 10-year peak out around 433. If you looked at where it peaked out back in last autumn, it was around 422. But at that time, the S&P 500 was trading around 3,500. Now it's 1,000 points higher. What's the difference?
I think the difference, one is just the economy in itself, Jess, that at that moment in time, we had much higher inflation and not growing as fast as we do currently. This year turned out to be an economy that's just much better than last year, even though last year still looked like, I guess if you came in early 2022 as a really, boom pandemic economy. But in fact, actually, we have a better economy this year. So I think that explains the 1,000 points difference. In addition to that, we obviously have earnings that have not gone into any recession. If anything, they actually showed some bottoming in that fall period, and they've actually moved up higher, right? And the projections are still higher. That makes that also the difference. And lastly, well, the 10-year topping out at 4.3 and change, just like we had this month, I think it does tell you a story about the disinflation being very successful by the Federal Reserve, both on inflation and now also showing up in the labor data. I think that too expresses itself into this higher stock market, showing that, one, we can keep pricing power. We don't have wages really spiraling out of control. We certainly don't have any recession near term, given the strength of the labor market. So I think that just leads you to this conclusion that you're having a stock market being better because of a better economy.
So what's the level on the 10-year that you're watching to where other asset classes would need to reprice, including the stock market, depending on where it would be headed? Say, would it be 4 or 5?
Yeah, that could be, it's kind of citing my old boss, Bill Gross, like he was the other day on TV, and kind of agree with him. Like, there's still that risk there that you have 4.5 as a level where if you do break that or test that we're getting a different situation, because there's another aspect here happening, that is that the economy is strong because we're investing in the economy with infrastructure and other projects and just business spending itself. But we're also borrowing there for a lot of money, right? And that will continue. That could actually keep rates at least higher or potentially test that level of 4.5. So that we do want to watch, despite we had a little bit of a rally down now from the last high. Just seeing it this morning, the ISM data being just surprisingly a bit stronger. Prices paid component goes up a little bit, and the 10-year yield immediately moves up from 4.07 to 4.15. That seems like an intraday move, but it does signify this idea of, it is an economy that stays strong. Be wary of